Good morning, ladies and gentlemen, and welcome to the fourth investment conference of the CFA Society East Africa. Thank you for being here this cold and rainy morning in Nairobi, but we promise it will be worth your while. My name is Boni Tunya. I'm a financial journalist across the continent, and I'm excited to be part of the conversations that will be happening here today. Ladies and gentlemen, this conference is very timely, as you might have seen through the publications that have been shared to you already. And it is timely in the fact that we're living at a very difficult time as a society. If you look at the conflicts across the world, if you look at Ukraine, if you look at the financial crisis, the risk of a recession, global concerns, floods, and an economy that nobody knows where it's to make these decisions, and how best can we inform some of the decisions that are being made across the concerned. And so the theme of this conference will be investing in a changing environment, and indeed it is changing. But the hope and really something to celebrate is that there is already a lot of good and positive work that is happening in this space. And in the course of today, we'll be listening to different speakers who will be highlighting this and bringing this to our attention, as well as while we count the gains, we'll also take stock of the challenges that do exist in our different markets. But ladies and gentlemen, to set the scene for us and just guide us through this and perhaps to welcome us officially to this space, it is my pleasure to bring on stage the CFA President for the Society of East Africa, Francis Nasiomba.
Thank you. Can you hear me? You can hear me? Okay. I assumed you'd have had breakfast. So my first words are to say it's a beautiful day, but I notice that most of you, when it rains, it stops being beautiful. But I believe it's still a wonderful day. Our chief guest, Cabinet Secretary for Trade, Investments and Industry, Honorable Moses Kuria. Our guest, nominated PS, Trade, Investment and Industry Ministry, Abubakar Hassan. The keynote speaker, Fred Swanika, the founder and CEO of the African Leadership Group. Our main sponsors, Kigali International Finance Center and Refinitiv. Our other sponsors, Sanlam Investments, East Africa Venture Capital Association, Nairobi International Financial Center, BDO and Synesis. The CEOs of various regulators, Mr. Wycliffe Shamia, CEO CMA Kenya, Mr. Keith Kalegira, CEO CMA Uganda, speakers and panelists, the Board of Directors of the CFA Society East Africa, the former President and mentor of the Society, Patricia Kiwanuka, former board members, CFA Society members, candidates and volunteers, industry practitioners and stakeholders, invited guests, the media, ladies and gentlemen, good morning. I welcome you to the fourth CFA Society East Africa Investment Conference, the first after the COVID pandemic, SE as the moniker goes. The last time we held this investment conference was in October 2019 in Kampala, Uganda. And as I can imagine, the conversations, the discussions, the resolutions, and the networking opportunities in no way anticipated the COVID pandemic. Handshakes and hugs were still a thing then. But human beings are resilient. Through history, across various challenges, both man-made and natural, healthcare or financial, from the major wars, plagues, including the bubonic plague, which is said to have wiped out 40% of the human population, we have always been resilient. We use the opportunity to bounce back, dust ourselves, learn, and maybe forget very soon after. I see you guys are back to shaking hands, and then regroup. And so is with the COVID pandemic. It has accelerated developments in investments and in the financial world and in the way of how we live. Technology has become central in everything that we do. And for that, we need to be cognizant of the fact that investments is evolving. Today, I just met one person who was at the COP's climate conference, and finance and investments and climate is becoming key in considering what we look at. We are actually very honored to have government in the room. A key conversation that is ongoing is the question about how government will work with private sector to ensure government delivers on its mandate, while the private sector, as you expect, also makes its returns. It's an age-old conversation, but we still have to have it. The CFA Institute and the CFA Society East Africa is working to increase the depth of knowledge and skills in the market. The CFA designation is a globally recognized by employers, by investment professionals, and by investors. It is considered a gold standard in financial analysis qualifications. It has more than 167,000 members across the globe. For your information, the world population just crossed over 8 billion the other day. The CFA Society East Africa covers Burundi, Kenya, Rwanda, Tanzania, and Uganda. That is a population of almost 200 million with a GDP of more than $230 billion. We have 216 charter holders and more than 700 candidates at various levels of the CFA exams. These are a pool of practitioners cutting across various professions and roles, from CEOs, research directors, investment and portfolio managers, investment analysts, educationists, and all. The program continues to move. And as much as recently, there have been changes to align and match that to the ever rapidly changing environment. So some of the changes that we are going to see in the CFA program: one, the new entry criterion is changing. So for the candidates, if you are in your second year of university, then you can start the CFA program. In East Africa, we now have 4 exam centers: in Dar es Salaam, Kampala, Kigali, and of course in Nairobi. A few years ago, you had to fly all the way to Dubai or South Africa to sit for your exams. We have 4 exam sittings in the year, and all of them are no longer the good old pencil and paper. So today, as we engage across board, I look forward to discussions on how best can we position East Africa to become a hub for global investing, and how best to improve liquidity across the East African markets. Climate change and investment decisioning is becoming a major issue. So how is ESG affecting our investment decision making? Last week, FTX went bust. With $32 billion, the cryptocurrency filed for bankruptcy. And with it, investor funding got lost. But let's be fair. Investment is a zero-sum game. One wins, the other one loses. But how does this augur with the new investment products and the asset classes that we are talking of? We have NFTs, we have climate funding. How does that augur with this? How do we use technology and artificial intelligence in decision making? I'm actually curious and honestly waiting for discussions because I'm worried about my job. So today, we learn and unlearn. And so, I welcome you and I urge you to engage with the panels, your fellow conference attendees, network, and have a great time. We intend to learn and question, to absorb, to share knowledge, enjoy and have a good laugh from Amandeep Singh at the end of the day, and of course to kick back and have even more conversations over a glass of your preferred drink and use that opportunity to network. So to you all, I welcome you to the 4th annual CFA Society East Africa Conference being held here in Nairobi, if you're in doubt, that is. So thank you. I would want to use this opportunity to acknowledge our guests, nominated PS for investments, Abubakar Hassan, and also use this opportunity to invite our chief guests, the Cabinet Secretary for Trade and Investments and Industry, Honorable Moses Kuria, for his speech. Thank you. A clap, please.
the President of the CFA Society, members, PS nominee for investments, ladies and gentlemen, good morning. It is indeed my pleasure to address you this morning. And first of all, congratulating you for holding this very important event. Now, I'm standing here, first of all, as one of you. I am a quack financial analyst. And having studied finance, some of us claim to be financial analysts, but actually our only claim to finance is that we pass through Modigliani and Miller. But I think for us, some of us, it goes beyond that. So, the fact that I'm standing here with a title investment with a name investment in my title is a clear proof about the government of Kenya commitment to promoting investments. And I think that this should send some hope. Yeah, I think I'll rather use this. Yeah, this should send some hope to all of you that the industry is still alive, there is hope, and for the first time in the Republic of Kenya, the government has deemed it fit to recognize the role of investment in driving this economy of ours. That we have a State Department for Investment, and our nominee, PS Abubakar Hassan, who is also one of you, currently serving as a Director for Market Operation of the Capital Market Authority, is in itself manifestation again about the government's commitment and recognition of investment and capital markets as an important player and engine to drive our growth. We have had very different conversation in this country. A conversation based on debt, a conversation based on borrowing, a conversation based on budget deficit. But for the first time now, we want to have a new conversation based on investment, based on opportunities, and based on shared prosperity. Under the State Department for Investment, the government is also taking a leading role by being the investor number one through our special economic zones. We've got around 9 economic zones that are going to fall under this new State Department for Investment. And that includes my favorite, my best, my preferred special economic zone, which is the Nairobi International Financial Center, which you are going to start developing anytime now. I have seen that part of your sponsor, one of your title sponsors, is Kigali International Financial Center. And I think PS Abubakar, I ask you to take note of that. The next CFA conference that happens in Kigali will be sponsored by the Nairobi International Financial Center. So it is good that Kigali has come kuchokoza, but you will take the battle right to their doorstep because the Nairobi International Financial Center that will be developing will have no equal or parallel in Africa. As a matter of fact, we look forward to having a financial center bigger than Singapore, big and Canary Wharf. And I can see that the Nairobi International Financial Center is going to be the home to most of you, so most of you here, because Nairobi will truly be the new capital of finance in the world, and the leading money center alongside the likes of London, Frankfurt, Shanghai, Tokyo, Dubai, and Johannesburg. Let me also say that on the 28th day after his swearing in, President William Ruto became the first president after the late Moi Kibaki to ring the bell at the Nairobi Securities Exchange on the 11th of October this year. That again should tell you and should tell the world about our commitment to reinvigorate the capital markets, the NSC, and to create new avenues for us to raise capital and to spur the economy. We've just agreed with His Excellency the President that before we break for Christmas, he will go back to the NSC, this time to ring the bell for the first ever asset-backed security that is going to be listed at the NSC and that is being promoted by the government of Kenya. And it's because we want to have new ways of looking at things. I even feel embarrassed calling them new ways when they are the norm. It's an ordinary thing out there to first of all look at capital markets to raise capital before going on Eurobonds and other expensive loans and other expensive means of financing our budget. Under the State Department for Investment, we have a body known as the Kenya Development Corporation, which is going to be our pace setter in matters of privatization. And you are going to see a lot of listings from the Kenya Development Corporation, which will evolve into our equivalent or the closest we could come to have a sovereign fund. So you can expect to have some transactions anytime in the market. I would have shared with you the list, but I might be accused of insider trading. So let me say that you'll get to know of them in due course. But as you know, ladies and gentlemen, our privatization process has been stalled for the last 11 years. Since KenGen and Kenya Re, nothing has been seen from our side of government, from the public sector, in terms of new listings at the Nairobi Securities Exchange. As we speak, after the President rang the bell at the NSC, he gave instructions that we need to amend the Privatization Act, and if that's not possible, to even repeal it so that you can have momentum in the privatization process. And a task force was created under the guidance of myself and Cabinet Secretary for National Treasury, Professor Njuguna Ndung'u. And I want to report to you that this committee, this task force, has now completed its work, and the repeal and the new Privatization Act is sitting with Attorney General as we speak. And you can expect that latest by end of February, we'll have a new Privatization Act and we'll kickstart the privatization process yet again after 11 years. So, kazi iko. And I want to challenge the CFA society to ensure that you also put your act in order. I want to ask our fund managers, our pension managers, to really also reciprocate this government gesture by allowing the funds that you manage to look beyond treasury bonds and treasury bills. Somebody said that insanity is doing the same thing again and again and expecting different results. So, I know most of you have been complaining that the government is not doing enough, but I can promise you and assure you that the shoe will be on the other foot. We are going to move at such a high speed, and I'm not very sure that you guys, our fund managers, our actuaries are going to catch up. Earlier this month, the President commissioned the Sanduku Investment Initiative that puts together our pension fund managers, actuaries, insurance companies, SACCOs, Islamic finance institutions, to create a vehicle to be a partner for government in transactions such as affordable housing projects, public-private partnership, and the asset-backed securities transaction that I've just referred to is actually going to be undertaken by that forum, by that platform, in partnership with the Ministry of Roads. So we are there and we are moving. And I urge you to keep pace, because soon, if you don't catch up with the speed that we are going to take off, we are going to start importing CFAs from Rwanda. And that is not very good. The other thing that I want to mention is that we are looking at public-private partnerships, which also fall within the State Department for Investment, as a new preferred form of financing our development. So today, if you are looking to give money to government, and then the government is supposed to take that money into housing, or into water, or into energy, we are saying, thank you very much, bring the money, but don't give that money to Treasury, only for Treasury now to turn that money into KenGens of this world, into affordable housing. Go direct. And we are in a very firm agreement with the National Treasury that they will only borrow money only when it is absolutely necessary. And if you come with the money, because I've seen some people say, we have this money and we have that money, we are saying that we are going to take that money directly into government projects through the PPP framework, which again you'll see a lot of development. There has been a lot of approach or focus on the top-down way of looking at things, and that's okay. There's nothing wrong with that. But what we are saying also is let us look at alternative ways of looking at this. As you know, the Kenya Kwanza government, our policy, our approach, our model is a bottom-up. On the 30th of this month, which is under 2 weeks away, the President will be launching the Hustler Fund. And this will have a big impact and a big fundamental sea change in the way we look at this economy. That for the first time, we are going to give loans at single digit to anyone, to everyone, without collateral and without security. And this will be the beginning of the downward spiral of our interest rate regime, beyond access to capital and access to credit. The government is also working on a national savings scheme for the hustlers under what we call the Kenya National Entrepreneurship Savings Trust, KNEST, which is going to address the 16 million people who are outside the formal pension structure. They are not in the public service. They don't have the white collar like most of you here. But they are also stakeholders in this economy. And I want to ask you and challenge you, in case you lost the memo, those 16 million people are still Kenyans. They still exist. So even as you pursue opportunities to manage pension fund for the white collar people, for the public sector, please also remember that there exist some 16 million people who do not have any access to any form of savings, structured savings, any pension, but they are still Kenyans, and we have to develop, we have to ensure that we also incorporate them into this train of savings and investment mobilization. As I conclude, let me mention one thing. There has been a lot of unstructured approach in the way we approach the issue of investment, both domestic investment and foreign direct investment. In this regard, the government is revitalizing the Kenya Investment Authority. Every time I am tired of people telling me that we were in Rwanda and we were impressed with the Rwanda Development Board. And if there's anybody from Rwanda here, we invite you back here by the first quarter of next year. And you learn some few lessons about how to run an investment promotion agency. In the first quarter of next year, we are going to host, Nairobi is going to host the Kenya International Investment Conference that is going to bring together global investors, global fund managers, global private equity, to showcase the opportunities that we have, especially within the public sector, within our PPPs, within our special economic zones, and generally within our economy. So I want to take this opportunity to invite you, Mr. President, and members of the society to join us in this conference and also contribute to this conference by sharing how our human capital, our CFA community can be part of the new journey to this new era of looking at investment as a way of growth. We have a little agreement that we've done with my colleague, the CS for National Treasury. And this is how we are framing it. These two Kenyas, the Kenya of debt, Kenya of budget deficit, Kenya that is led by public sector at the detriment of private sector, we are referring it to the old passport. And that is under my colleague, Professor Njuguna Ndung'u. And I am the Prime Minister of this new passport, based on investment, based on trade, based on opportunities, and based on shared prosperity. And I want to ask you today to choose which passport you want to hold. If you want to hold my passport, I'm around. I've got some application forms. You may see me before I leave. I thank you, and I want to wish you fruitful deliberations. Thank you.
Thank you so much, Waziri, and thank you also for the invitations and the challenges that you've passed. I think it's fantastic that we are going into a very brave new world where we are actually challenging the opportunities that do exist in front of us. So I'm really excited just to listen to all the opportunities that Waziri has mentioned here in the next few months. Ladies and gentlemen, I'd want us now to take a few moments to listen to our keynote speaker. Now, this is a gentleman who a lot of us have a lot of respect for, has been dubbed one of Africa's smartest. He is on a mission to bring better leadership to the African continent and the world. He leads the African Leadership Group, an ecosystem of organizations that aim to catalyze a new era for ethical, entrepreneurial African leaders for the continent. Over the past 15 years, he has founded and led Africa Leadership Academy, an African Leadership University, African Leadership Network, and The Room, which is basically a community of global leaders committed to unlocking opportunities for undiscovered talent starting in Africa collectively. And these endeavors aim to transform Africa by developing 3 million African leaders by 2035. This gentleman is well celebrated in the academic space. He's an entrepreneur and a truly African giant. Ladies and gentlemen, my pleasure to bring Mr. Fred Swanika. Come on, let's keep clapping till he gets here.
Chief guests, Honorable Moses Kuria, the Cabinet Secretary for Trade, Investment and Industry, the Government of Kenya, P.S. Abubakar Hassan, distinguished ladies and gentlemen, all protocols observed, good morning. These are tough times that we meet in. Started first by the pandemic. It's just been one piece of bad news after another, right? We from the pandemic, we went to supply chain issues that we saw, containers stuck in China and everything like that. Then the Ukraine war, and then that led to rising food prices, inflation all around the world, being driven by monetary policy in the West. And then that led to devaluation of currencies in some emerging markets like here in Africa. In Ghana, where I'm from, the currency has dropped by 40% just in the last couple of months. You then see rising interest rates, geopolitical tensions between China and the USA and Russia, and you're starting to see a split in the world. And so many things. We don't know what's next. It seems like one punch after another. So we're living today in a rapidly evolving landscape, which is why the theme, investing in an evolving environment, is quite an apt theme for us today at this conference. So as investment professionals, it must be such a bewildering time where there's so much uncertainty and you don't know where are the opportunities. How do we deepen East African capital markets in such environments? What about environmental, social, and governance issues? Artificial intelligence and technology. What is that going to do? How is that going to impact your role? The only thing that is certain right now is change. That is the only thing that we can count on. And so how do you make decisions in times of uncertainty and rapid evolution like now? In my work at the African Leadership Group, I'm passionate about leadership. We spend a lot of time thinking about what it takes to develop leaders, to connect leaders, to help them to reach their full potential. And so today, I want to share with you 4 things that I believe could be helpful as you think about your role as investment professionals in this specific moment of rapid change and uncertainty. The first recommendation is don't panic. This moment calls for exceptional leadership on your part as investment professionals. In the African Leadership Group, we talk about the 7 meta skills of the 21st century. These are skills that we believe that leaders need to be effective. These are skills like leading yourself, leading others, thinking critically, communicating for impact, leveraging data to make good decisions, solving complex tasks. These are the skills that you'll need to call on. At this moment, though, I believe that the most important in times of crisis is leading yourself. How do you regulate your own emotions? How do you lead in a non-anxious way? How do you remain centered as a leader when everything else around you is evolving and rotating? These are the moments where you as a leader need to really be more reflective and to take a step back in the middle of a crisis situation. We talk about going from the dance floor, where you're right in the mix of everything, in the middle of the chaos, to stepping back and going onto the balcony and looking down and seeing the bigger picture and trying to see the trends that are emerging so that you can make a better decision than get back down into the dance floor again. But ultimately, the way you lead yourself and the way you manage your own emotions and stay calm at this moment is going to be a critical factor in your success and your ability to make good decisions. Because very few good decisions are made in a panic. I'll tell you an example of how we did this in the African Leadership Group and what the results have been. In January 2020, we began with a plan to scale up our operations. We develop leaders. We select young people, we train them, and into the next generation of leaders for the continent. We were planning to open sites in 8 countries and to select about 1,000 people in each site. So we're going to train about 8,000 people in bricks and mortar spaces with faculty who would be present in person. And that was our plan. And then, of course, we all know what happened in March, the pandemic, right? And when it happened, I remember I was in Portugal a couple of days before, and I flew into the country. I was on the last flight before they closed the borders, and I got back into Kenya, where I live right now. I'm Ghanaian, by the way, but most people think I look South African, but I live in Kenya right now. And when I got back and started looking at what was going on in the world, I made a critical decision. I decided that we would stop. Well, the first thing we did was we dealt with the crisis. We made sure that all of our students were safe. We transitioned all our learning online, ensured our staff were safe, and so forth. That took about a week or so. And then decided that we would stop the entire organization for a month, and we were just going to think. So every person in the organization became a strategist. Normally, strategy is done from the top down. The board meets with the CEO, they decide, and then they just go and tell the team what to do. We decided that we would pause all operations for a month, and all 100 staff that we had at the time became strategists. And we read hundreds of research reports. We interviewed experts in different areas, talked to futurists, tried to imagine what the world would look like post-pandemic. And we paused everything. We didn't do any work except think for a month. Coming out of that, we identified some trends that were going to change the world post-pandemic. For example, the rise of digitization. We realized that the world was going to become much more digitized post-pandemic. We realized that there was going to be an economic recession. And we identified in that time that the pandemic was going to last probably for another 2 years to 3 years. So we needed to think about how we could continue operating for such a period of time when you couldn't gather people in person and so forth, right? And so it radically changed our operations. We became entirely digitized, both in terms of how we were running our organization. We started operating completely virtually. And in terms of the training that we were giving to young people, we decided that we would begin training software engineers and data scientists and cloud computing specialists because we realized where the world was going. As a result of those decisions, and more importantly, the time we took to think and not panic, in the last 12 months, we have grown by 2,000 times. A year ago, we were training about 50 software engineers. Today, we're training 100,000 software engineers. We have gone completely digital, and we have expanded to countries and villages and parts of Africa that we would never have been able to reach. It has also evolved our business model, where before we were sustaining ourselves by charging young people fees to attend these programs. But we realized as we started to build this pool of technology talent that there's a massive global shortage of technology talent. There's 50 to 85 million jobs around the world that need technology talent. And China is aging, India is aging. The only place that they can get the talent now is in Africa. And so we're now building a technology services industry, business, similar to Tata Consulting Services or Infosys or Accenture, to tap into global demand for technology talent, but that will serve from Africa. And that's now how we're sustaining ourselves. So a lot of rapid change happened, but we leaned into it and took the time because we didn't panic. And as a result, we're now growing much, much faster and have a much more sustainable, effective business model. And so that's the first piece of advice, is not to panic. Take the time to think, especially in moments of crisis. The second piece of advice that I would share is to find the silver lining in every challenge. We all know the saying that behind every crisis is an opportunity. So we have rising food costs. Well, that's a great opportunity to get into agribusiness and to start to reduce. We spend $50 billion a year importing food into Africa. That we have perfect soil conditions and rain and abundant sunshine that we should be producing for ourselves, and going beyond just production into processing and managing supply chain of food and agri-tech and so forth. There's so many opportunities when you start looking at that space. There's rising interest rates. Well, that creates opportunities for fixed income investments. Stock markets are crashing. Well, that means there's great opportunities for you to find stocks with better valuation than before. And it gives you better leverage in negotiating with business owners about the valuations of their companies. Because if you remember what happened the last couple of years, the fundamentals got out of whack with the valuations that people were asking for their businesses. There's been a devaluation of currency. Well, that creates opportunities in export-oriented businesses, like tourism. Americans are feeling richer now. So what are we doing to attract them to come to Kenya and to East Africa more broadly, because they can afford to, things suddenly are much cheaper for them. How are we repositioning Africa as a place for tourism, because now suddenly it's much more affordable for people, for example, from the US to come here. Manufacturing, fantastic time to get into manufacturing right now, because of with the devaluations, suddenly your goods and services, your goods become cheaper. Services, the pandemic has led to the rise of remote work. So how do we reposition Africa with its abundant pool of talent for services for the rest of the world? India earns $230 billion a year in foreign exchange from exporting its technology services. 6 million software engineers, they sit in India. 90% of that revenue comes from outside of India. And they're servicing the whole world. How do we reposition Africa to do that? And this relates to another opportunity. The aging population in the rest of the world. The average age of an African is 19. The average age of a German or Japanese is 48. It's a huge opportunity for us in Africa. How do we export our talent and use that export to drive wealth in Africa? In that export, the good news about this moment is that you can export our talent without the brain drain for the first time in history, right? You can be a software engineer sitting in Kenya working for a company in Dubai. You can be a UX designer sitting in Nigeria working for Zara in Spain. And this is one fantastic opportunity. But we can also be deliberate about investing in our human capital and exporting them physically. There's a massive, as the world is aging, people need nurses in the West. They need elderly care more broadly. Let's produce hundreds of thousands of nurses and ship them abroad. Deliberately identifying the human capital needs of the rest of the world, producing them in Africa and exporting them. And with that, you get foreign currency coming back into the country, into the continent, through remittances and so forth. But we have to be deliberate and take advantage of these global translocations to Africa's, so that Africa prospers. We talk about rising geopolitical tensions. Well, this is a fantastic opportunity to position Africa as a neutral third party and get global companies to come and set up operations here, to diversify their supply chain, because countries now realize that, or the West is now realizing that they're over-dependent on China. And so they now need to find other places to set up manufacturing plants and so forth. How are we positioning ourselves and say, hey, we're not allied with the US, we're not allied with China, we're in between, we're neutral. Come and set up operations here. And we can diversify your supply chain and so forth, right? Technology. You can either be scared of it with all the disruption that is taking place, or you can lean into it and use it as a tool. Think about all the opportunities in digital health, digital education, even real estate. Across Africa today, in the next 30 years or so, over 700 million people are going to move into African cities from the rural areas. This is a massive challenge in terms of housing, sanitation, traffic, urban planning, urban governance, and so forth. But it creates tremendous opportunities for investors. Who's going to create the low-cost housing in all these cities? Who's going to clean up the garbage in all these cities and make sure that they're green and clean? These are all business opportunities. I'd like to show you a radical and unconventional way of thinking about it, using technology. Today, to build a house, low-cost housing, $20,000, $30,000 minimum dollars per person, per house. But there's technology that has been developed that allows you to 3D print a house in less than 24 hours for $4,000 per house. I want to show you a quick video. Can I have the video, please? That shows what is possible when you start to lean into technology and actually see it as a tool and not only be scared of it. Can we play the video? So those houses were printed in 24 hours. They cost $4,000. as we think about solving our problems in Africa, we have so many challenges: healthcare, climate change, infrastructure, urbanization. How do we use technology as a powerful tool to solve these problems in radical, unconventional ways? We shouldn't be doing things the traditional way. We need to reinvent and reimagine. And technology is a very powerful tool in doing that. Who amongst you is going to finance construction of our cities using radical, unconventional methods like this? That has happened. It's happening in Latin America. Why are we not doing that in Africa? We should be leapfrogging and building the cities of the future using radical methods like that. Of course, seeing how can you do that to also be climate friendly, and leapfrogging, leveraging technology to actually show the rest of the world how you can develop in unconventional ways, because we have no choice but to do things differently. We don't have enough time, we don't have enough money, and when you have constraints, you have to innovate. And innovation is why also tremendous opportunities lie for investment. My third piece of advice is to upskill yourself in this moment. During times of rapid change, you need to keep up with the times. You need to keep learning as a leader. We're talking about all these trends in environmental, social governance, ESG, investing. What are you doing to upskill yourself in that space? What are you doing to train yourself in carbon finance? Today, there's a huge opportunity with climate change. Billions, trillions of dollars are going into this space. But when you look at carbon assets, Africa has tremendous carbon assets. We have, a lot of forests and mangroves, the blue ocean, the blue economy, blue carbon. There's tremendous carbon assets in this continent. But today, who has the skills to package carbon projects? It's not African professionals. We have to import people from outside of Africa to come and package, because it's complex to put together a carbon deal. We're bringing consultants from the rest of the world to come and value our carbon and tell us how we can put them on the global capital markets. Are we playing in that space? Do we have the skills in Africa? So what are you doing to upskill yourself in this space so that you can use your analytical capabilities, your financial structuring capabilities, your legal capabilities to put together, to value the carbon that we have in Africa and put that on the global capital markets and attract some of those cash flows into this continent? Those are all great investment opportunities, but it only happens if you skill yourself. When you talk about technology, what are you doing to upskill yourself in areas like data science, cybersecurity, cloud computing, virtual reality? These are technologies that are not going anywhere. Internet of Things, sensors. How many of you in this room know about GPT-3? Can I see a show of hands? It's just something that you need to know about. GPT-3 is a very unique form of artificial intelligence. It uses neural networks and natural language processing to scour the world's knowledge and use it to answer questions that you might have. It's essentially pulling together all the knowledge that exists in the world today on the internet and can respond to queries that you have about anything that you want to know. I want to demonstrate this in action to you live. Can I have the GPT-3 playground, please? This is a tool that you need to know about. So I'm going to ask it a question. The question that I'm going to ask it, can you guys see the screen? How can East Africa deepen its capital markets? That's the question we're asking this artificial intelligence. Let's see what it says. This is artificial intelligence answering this question? Can you take a moment to read that? It's looking at the internet, and it has, who here thinks it has given coherent answers? A machine has answered what East Africa can do to deepen its capital markets. Volunteer for another question you want to ask the system? Who has a question you want to ask AI? You're sitting in a moment of rapid evolution. What question? Any volunteers? Mr. President of the CFA Society, what question should we ask the machine?
How do we grow our financial talent?
Okay, can you type that in there, please? How do we grow our financial talent?
East Africa.
How do we grow financial talent in East Africa? Delete everything and ask that question. You have to delete everything first. And then the question, how do we grow financial talent in East Africa? I can't read from here. What is it saying? Is it making sense? What is it saying? I can't read it. The second sentence, Yusuf, what does it say? You need to include training and education opportunities for young people. Support entrepreneurship, yeah? So, this thing is learning all the time. This is what you call machine learning. If you don't know what GPT-3 is, you're going to be left behind. So what are you doing to skill yourself in this moment? And this is just one of many, many emerging technologies that are taking the world by storm, in which if you want to remain current and to keep your jobs, don't hide, don't run away from technology, learn about it, upskill yourself, become a student, so that you can compete in this moment and leverage it to find great investment opportunities. My final piece of advice is to have a long-term philosophy. Think from first principles and understand long-term trends that are not changing. And then bet on those areas as you invest. So in the African Leadership Group, as we develop leaders, we challenge them to do hard things, to solve problems for Africa. We've specifically identified what we call the 7 grand challenges of Africa and the 7 great opportunities. The 7 grand challenges are big problems that we need to solve, where Africa is starting from a difficult place. These are things like healthcare, climate change, governance, youth unemployment, infrastructure, and urbanization, right? These are big, big challenges that we're facing in Africa. Then we have another list of what we call the 7 great opportunities. And these are where Africa has been blessed with low-hanging fruit that we haven't yet captured. For example, agriculture. I talked about that earlier. There's no reason why we should not be one of the world's best in this area. The empowerment of women, huge untapped opportunity. How do we bring more women into the workforce, give them opportunities, and unlock 50% of our human capital of this continent to its fullest potential? Wildlife conservation. We have unique assets, untapped. How do we position that as a force for economic growth? Regional integration with the Africa Continental Free Trade Area. What are we doing to to capture all the opportunities that come from a much bigger transcontinental economy, right? As we break down barriers between our economies. Individually, our economies are too small. But once you start to aggregate the African continent, suddenly you can build businesses of scale, right? The arts and the creative industry, huge opportunity for Africa. And the nice thing about that, it doesn't require much capital, it just requires brain power and creativity, which we have in Africa. Right? Natural resources, tourism, these are all untapped opportunities. And so as you think about these trends, they're long-term trends, 30 to 40-year trends. That's where to invest. These are where the challenges are, because when you're able to solve problems, you're able to then create value. Another aspect of long-term thinking, and this is what I want to end with, is that ultimately, I believe that if Africa is going to get wealthy, we have to really think about long-term what creates wealth in society. I have a very cynical view of this. I believe that there are ultimately two ways in which societies get wealthy. The first option is you go and steal it from another society. So this is what the Greeks and the Romans did 2,000 years ago, the Vikings when they went and pillaged Europe. Spain was built by pillaging Latin America. Portugal, the same thing. The UK stole from the whole world as they colonized us. America was built on 400 years of stolen labor from Africa. Pathway A is you go and steal it, and you get wealthy that way. Pathway B is the more humane way to do it, which maybe protects human rights better. You produce something for $1 and you sell it to the rest of the world for $20. This is what China has done with manufacturing. This is what India is doing with services. Why is that so? Because the African consumer is not very wealthy. So if we're producing things and trying to sell them in Africa, for example, Ghana and Nigeria make 70% of the world's cocoa. But yet, there are no global chocolate brands from Ghana or Nigeria. We're buying Lindt and Cadbury and all of these British and Swiss chocolates and things like that. If a Ghanaian entrepreneur gets a brilliant idea, say, okay, I'm going to develop world-class chocolate, and you produce it for $1, and you try and sell it in Africa, you'll be selling it for 50 cents. Because the African consumer cannot afford it. We don't have a lot of wealth today on the continent. So what you'll be doing when you're trying to sell only in Africa is you'll be exporting poverty from one part of Africa to the next. You won't be creating new wealth because the stock of the wealth that you have needs to come from somewhere else. Same thing within our capital markets. You have to attract it from other places into this, because African capital markets are shallow. So how do you create the right environment to attract it from the rest of the world? You have to produce something for $1 and sell it to the rest of the world for $20. Tesla cannot manufacture its cars without cobalt from the DRC. Yet we get cents on the dollar and Elon Musk makes all the money in California. Apple cannot make this iPhone without coltan from the DRC. Yet we get cents on the dollar and all the wealth is created elsewhere. So until we learn how to manufacture those, until we learn how to add value, until we learn how to produce something for $1 and sell it to the rest of the world for $20, we are going to remain poor in Africa. Because we just cannot, we have to basically find a way to steal the wealth, but to do it legally. Because I don't think anyone here wants to go the route of colonization, which leads us this other pathway. And you see an example of this in what the Nigerians are doing with music. The Nigerian musicians have gone global. Every global musician now needs to partner with a Nigerian musician. Justin Bieber needs to do a collaboration, Ed Sheeran, Rima did something recently with Selena Gomez. They sell out stadiums, right? Madison Square Garden in New York, O2 Arena in the UK. And these Nigerian musicians, Davido, Burna Boy, they're being paid millions of dollars on the global stage. And then that cash comes back into Nigeria, and it funds the local music industry, and it's producing jobs for producers and mixers and lawyers and everything that are involved in the entertainment industry. We need to do that in every other field in Africa if we want to get wealthy. Because otherwise we're just going to be exporting poverty from one part of Africa to the next. And so as you think about where you invest, the kinds of businesses that are going to create wealth in Africa, I want you to think about this long-term challenges and opportunities and these long-term sort of principles of economics and how societies get wealthy. So that's it. 4 things that I hope can help you as you think about how to deal in this moment. Don't panic. Keep upskilling yourself. Think about these long-term trends. And finally, find the silver lining, because behind every challenge is an exceptional opportunity. Thank you.
A proper round of applause to Fred Sonika for his thoughts. Thanks so much, Fred, for that challenge and very insightful presentations. I think biggest takeaway of the day is GPT-3. Okay, great. Ladies and gentlemen, at this point, I'd like to acknowledge that this conversation and this conference couldn't happen without the collaboration of partners. And I'd like, at this point, to bring on stage Ms. Candice Dott, who's a global head of sales and strategy for sustainable finance and investments at Raffinity, which is part of the LSEG business. Round of applause, please.
So good morning, everyone. Fred, it's an absolute honor to follow you, actually. You're somebody that I've always loved listening to, and I could listen to for hours and hours on end, so thank you. I really enjoyed your keynote. For everyone in the room, I've just been introduced. I'm Candice Dott, and it's really an honor to be able to sponsor, and I think the word partnership was used just now. And personally, for me, I see quite a number of things that come from key associations like the CFA as being true partnerships, and I think it's an honor to be able to partner with the East African CFA Association, so thank you for having us. I look after a business within our London Stock Exchange group that covers our sustainable finance and investment solutions. And it connects to, obviously, our first panel today, which I'm particularly excited to listen to, one of our members of our teams on that panel. But I wanted to quickly draw a little bit more reference to the organization that I work for. So the London Stock Exchange Group, and to many people in the room, and many, many times over, I have to spend quite a lot of time reintroducing what the group actually is and how we help solve community challenges, market challenges, and help enable financial markets. As many of you, or hopefully some of you know, Refinitiv became part of the London Stock Exchange Group in February last year. And effectively, the London Stock Exchange Group, and for many people in the room, often you might have come across the London Stock Exchange. Yes, that's part of the group. But effectively, we are more than a diversified global financial markets infrastructure and data business. We have extensive experience, deep knowledge, and a worldwide presence across global financial markets. We provide services right across the investment and trade lifecycle value chain, and our solutions enable seamless workflows to our customers and help to improve market efficiencies and shape the future of our industry. Some of you may have come across us in different capacities, but I'm going to share 4 of those areas within the group with you today. Firstly, starting with capital formation and issuance. And what I mean by that is capital raising, and effectively our primary markets business, which is operated by the London Stock Exchange Group. The London Stock Exchange, sorry. Second is pre-trade and liquidity discovery. which you can see through our data and analytics solutions. We are the world, or one of the world's leading providers of financial news, data, analytics, and we have an unmatched depth and breadth of content. We're an exclusive supplier of the world-winning, trusted Reuters News. Yes, we still often get asked, are we part of the Reuters organization? We absolutely work very closely with Reuters still. We supply real-time market data all over the world. And we also have FTSE Russell, which is a global leading index provider that calculates indices and benchmarks across more than 70 countries all over the world. We work in partnership with organizations, governments, and global corporations, helping to tackle things like financial crime, green crime, and helping with illegal wildlife trafficking. So some of those key trends and future investment areas Fred referenced, I think fit into that category, something we could be exporting. We help mitigate exposure to customer and third-party risks, and many of our clients rely on our KYC services to do that globally to help support international trade. The third area is trade execution. And trade execution for many people in the room may be something that you're familiar with using our desktop services, either Icon or Workspace now, where we are the leading trading venue across many different asset classes, specifically foreign exchange, fixed income, and equities. TradeWeb, which is also a company that we are a majority share owner of, continues to launch new fixed income products globally and help to gain market share across fixed income markets through effective fixed income trading. We've also recently launched a voluntary carbon market, and that helps to facilitate the financing and scale of projects that help mitigate climate changes. The fourth area is post-trade and capital optimization, where we are the leading multinational clearing and reporting service called the London Clearing House, or LCH, this is commonly referred to, and also via another company called Univista. Data in the post-trade space often helps provide pricing and reference services across over-the-counter instruments, provides post-trade analytics that helps support risk, balance sheet management, and overall financial portfolio management solutions. We've heard a number of our speakers earlier reference a number of the challenges that we're all facing globally. And I think, importantly, we're going to hear quite a lot about the local context and a lot of the opportunities. I really like your reference, Fred, to ensuring that we always look at the silver lining, because I do believe that when we get too bogged down by a number of the challenges, we end up spending a lot of time focusing on those challenges and forgetting how many opportunities there are ahead of us. And one of the areas I'm going to focus on is the area that I'm specializing in, which is really to do with our sustainable financing and sustainable investments business. And in line with our first set of panel speakers earlier, just now, who are going to be covering ESG in specific reference to ESG and investing, I wanted to focus on two quick areas. One of which is, what is the role of stock exchanges in helping with regard to achieving net zero? And two, how can regulators and their role help enforce sustainability disclosure and standards? And I'm a particular fan of the CFA ESG qualification. And it's something that, for many of you in the room, you've either already done or I think are hopefully looking at doing. But as far as I'm concerned, most people that I meet that have done that qualification topics. And the one, obviously, from a stock exchange point of view, as LSEG is a diversified and market infrastructure player, we service clients in many different shapes and sizes. Those clients include investors, and many of our investors are very reliant on climate data and analytics. And that's becoming vital for decision making in almost everything that they're doing. Investors are increasingly allocating multi-asset portfolios to account for climate risks and opportunities. High-quality climate data is essential for all decision-making. and ALSEG plays a leading role in helping disseminate that information. Our ALSEG business helps provide ESG scores across more than 10,000 companies with over 100 metrics per issuer with regard to climate. That covers climate data with regard to scope 1, 2, and 3 emissions information, as well as those companies that publicly disclose their net zero targets. We also track the global green bond issuance, and I know in particular that Kenya has been world leading with regard to the green bond markets that they've been running, but also that's something that I think a lot of East African countries have been looking at through their stock exchanges. Interestingly, ESG Sukuk issuance has also reached new highs. In 2021, total issuances for the year amounted to $5.3 billion, as ESG issuances across the world gained traction across new markets in the wake of COVID-19. ALSEG's index provider, FTSE Russell, provides green revenues data to over 16,000 companies, and that data is used by investment professionals both to help manage passive and active funds and exchange-traded funds globally. Our multi-asset climate benchmarks are rapidly growing in coverage and adoption. Just to put that into perspective, there is about $260 billion passively tracking FTSE Russell's range of sustainable investment indices globally. This is a growing area of our business, and it's growing far faster than the non-sustainable investment indices. We've seen major asset owners switch multi-billion-dollar portfolios to climate benchmarks, aligning their goals to the Paris Agreement, with this being particularly emphasized across the UK and across EMEA. We're seeing many other markets following suit. After excluding high carbon sectors, these benchmarks reweight stocks and bonds on their climate data, and as such, account for using information that's been shared across carbon emissions and green revenues. As capital continues to flow into these benchmarks, this offers an incentive for corporates to up their game on both climate mitigation effects and also their financial disclosure with regard to climate. FTSE Russell is also expanding its coverage of climate benchmarks both across equity and fixed income to cater for investor appetite in both of these growing areas. And in 2021, 84% of asset owners surveyed by FTSE Russell were either implementing or evaluating sustainable factors into their portfolios. This figure has risen further in 2022. For corporates and sovereign issuers, as another customer segment, access to green finance is becoming crucial to help accelerate decarbonization. ALSEG's capital markets business, contained within the stock exchange, helps do this and is a key source of green finance for corporates all over the world and sovereign issuers. Over £130 billion has been raised by the London Stock Exchange in their sustainable bond market, with more than 30 billion raised in green bonds in 2021. The LSE also has a green economy mark, which offers London-listed companies with high exposure to the green economy with greater exposure to investors. And over 108 companies and funds listed, combined with a market cap of £156 billion, now wear that green mark. The LSE has also launched the world's first transition bond market in 2021. Although it's still a pretty nascent financial tool to be used, it's helping high carbon issuers with credible climate transition plans access finance. Stock exchanges globally have a key and very influential role to play in shaping sustainability disclosures and the requirements for listed companies. Our group has partnered with the UN Sustainable Stock Exchanges Initiative to accelerate the adoption of the Task Force on Climate-Related Financial Disclosure, also known as TCFD. And the LSE was also the first exchange in the world to issue a reporting guidance around its TCFD disclosure last year. Now, I know the Right Honourable Minister and his team have left the room, but hopefully we've still got a few people who work within different regulator capacities still with us. So touching on my second topic and just sharing some global insights. I think it's key as an exchange and often the role that different regulators are able to play in helping enforce sustainability, disclosures and standards, and in ways that regulation can help bring along transparency, harmonization, and a greater impact to global financial markets. Financial markets rely on a common language. The current consensus around financial reporting has taken many years to perfect. We're now looking for a common language to be used across sustainability. And the metrics that companies are going to be used to report their sustainability financial market data is really going to be key. A consistent approach to global sustainable reporting standards is urgently needed. Capital is not yet flowing fast enough into industries that are decarbonizing already and diversifying their businesses. And one of the barriers to prevent some of this capital in accessing and mobilizing the capital is access to the right data to make those informed decisions. And data was a key area that Fred also touched upon. Low figures are not just the result of a lack of desire. The issue is that there is a myriad of climate reporting standards out there that has created the unintended consequence of confusion and inefficiencies, which have really created a significant burden on those institutions needing to report. This is overstretching investor relations teams, sustainability managers across corporations who are actually all struggling to answer pretty complex questions around their carbon reporting across their supply chains. And they're having to navigate multiple standards, multiple bodies who haven't yet agreed on a single framework. Growth across small and mid-cap companies is also limited, both due to capacity within these firms and often expertise. So they're not well equipped to be able to disclose their climate transition plans to investors. And those are specifically the firms that often need the financial capital the most. A disclosure gap is one of the biggest challenges we face. And research by the FTSE Russell team found that 40% of large and mid-caps globally are still not disclosing their Scope 1 and 2 emissions. Disclosure varies drastically across all regions in all markets, and trust me, I'm exposed to that every single day. And there are major issues using estimates. A lot of people are starting to use estimates with regard to estimating carbon emissions. Half of these estimates values diverge from their reported data by over 100%, and at least a further quarter of those values are about 200% wrong, effectively. ALSEG is calling on policymakers everywhere to take 3 steps to help change sustainable access to finance. Policymakers can help to drive growth and innovation in the global economy while supporting the transition of their broader economies in parallel. You no longer have to make an or decision, it's an and decision. Mandatory sustainability disclosure rules can be critical in this regard. So the 3 areas that the ALSEG team proposes and recommends for policymakers to consider are, number 1, in 2025, we want to see governments introducing domestic disclosure frameworks on an economy-wide basis with regard to the task force for climate-related financial disclosure. 2, policymakers should require companies to show the breakdown of green and non-green revenues, helping investors make more precise green economy investment decisions. And the 3rd area is mandatory publication of climate transition plans across the global economy. These plans will publicly show out how and in detail a company is able to reduce its carbon emissions. And our CEO, David Schwimmer, is actively involved in the new UK government's new transition plan task force to help set the global standard for what crucial climate transition plans should look like. All of these policy recommendations can be found on our website if you're interested in reviewing them in more detail. But hopefully through some of the examples that I've just shared with you, you're all able to see exactly how dedicated LSEG is in helping tackle the world's urgent challenges and enabling sustainable growth for economies globally. And that's why we are laser focused on the permanent fusion of finance and sustainability to leverage value and to realize this vital paradigm shift. I particularly like Mark Carney's quote, and for those of you that don't know Mark Carney, he's the UN Special Envoy for the Climate Action and Finance team. For the world to get to its objectives, we need but at the pace of the digital transformation. I'd like to thank the CFA Association for allowing us to sponsor your event today. I look forward to our panel and for all the other panels and breakout sessions that we're going to hear from various speakers and industry experts from across the East African region today. And just a quick reminder, we do have a team, a phenomenal team, in fact, that I haven't been able to share much time with since pre-COVID, but I'm based in our Johannesburg office. I'm very proudly South African, very proudly love working with our team, and all of our team across our African continent are actually here today in order to be able to share more of our knowledge, some of our experiences, and hopefully be able to help you with solutions. So please come and visit us at our desk outside, and we'd be very, very willing and keen to show you a lot more of some of the things I've discussed and other questions or challenges you might have. Thank you very much, everyone. Have a lovely day.
Thank you so much, Candice, for your thoughts and for sharing that with us. And thank you really for your presentation, because it segues perfectly into what you're going into. We've talked about investing in an evolving environment, and one of those environments is not a financial environment, but the actual environment in which we live in. There's a lot of concern that perhaps investors need to think critically about the planet. And ESG as a key investment space has been identified and highlighted. And that will be this topic of discussion in our panel starting now, that will tackle the question of environmental, social governance requirements in investments and investment decision making. This panel will be moderated by Christine Mwangi, CFA, who is a regional coordinator for Africa Sustainable Investment and Infrastructure at the Worldwide Fund for Nature, WWF Kenya. I'd like to invite Christine on stage, and she will introduce her panel. Round of applause, please.
Good morning, everyone. I would like to invite to the front three ladies. We have in no particular order. Ladies have Ashmawi, Nasrananda, and Lois Wangui. Please come to the front. I will share your profiles with you. On ESG requirements in investments and investment decision making. We seek to understand more about ESG in the context of investment management. Three simple letters, yet possibly very complex. We'll be looking at the opportunities and challenges for ESG investors and the role that regulators can play towards contributing or supporting investments in ESG. And finally, we'll also be having snippets on potential stakeholders with whom we can collaborate towards achieving these objectives. And to be able to do this, in no particular order, I'll start off with the far left.
we have Lois Wambui, and she's the Chief Officer, Regulatory Affairs at the Nairobi Securities Exchange. And she leads the function of market surveillance, financial and sustainability reporting, and listening to the objective of promoting
ethics, fairness, transparency, and the trading of securities. Lois holds a master's in law in public finance, and she's passionate about helping companies address the shift in assessment of corporate performance to include both financial and non-financial performance. And it's in that regard that in 2021, and she'll be telling us more about this, she led the design and development of the first ESG disclosure guidance manual for listed companies in Kenya. So welcome, Lois. And next to Lois, we have Mehitab Ashmawi, a CFA charter holder. And she has more than 14 years experience in the financial field, currently working as a senior customer success manager covering investment and advisory at Refinitiv, a London Stock Exchange business. And she's worked with various firms. She's also an MBA graduate from École Supérieure Libre des Sciences Commerciales Appliquées, ESLCA, and she also holds a certificate in ESG investing from the CFA Institute. And next to me is Nasra Nanda, the CEO and ESG lead for Green Building Society, and also a special elect member of the County Assembly of Nairobi. Passionate and hard-working individual, a lawyer by profession, and who is passionate about ESG and believes in doing things sustainably that serve us all, and very excited to work with the interplay between law, business, and human rights and environmental issues. So her work is mainly focused on policy. So we have a rich set of knowledge in front of us. And perhaps just to unpack this, we'll start with Mehitab. You could share with us what really is ESG in the context of, or for the benefit of investment managers, and what is it not? No, who's this?
And ESG investing in general is one of many types of investment approaches under the responsible investing umbrella. So when it comes to ESG, and we had all of our speakers speaking about it, and how to incorporate these three pillars into investment management and for a portfolio manager, thank you so much. For a portfolio manager to, or a wealth manager to include in their models and their investments. So it's mainly about opportunities as well as risks that falls under the three pillars, the E, environmental, the social, as well as the governance, in order to sustain and to have a long-term return for our stakeholders, the stakeholders in general, not only investors, but all stakeholders within a corporate, in the capital markets, as well as in any, in the country. So this is what it is. What it isn't, it depends on you. So as Fred was saying, that ESG knowledge and literacy, it's very, very important. We need to understand what ESG is in order to decide what...
Thank you, Mehi, and I think that has thrown in other terminologies that we may not be aware of in this room, but if that's the case, then we'll throw that challenge to the CFA Society East Africa to figure out how they ensure that we get to understand those terminologies. Now, the other question is ESG investing a strategic or a compliance decision? Or is it both?
And perhaps we could look at this from speaking to Lois. From the compliance side of things, you helped set up the ESG disclosure manual. So what is the value, or what would be the value of this manual to the either, or these disclosures to the listed companies and existing and potential investors?
Thank you. Just to take us back to where the decision to actually have an ESG guidance manual for the capital markets in Kenya came from. It was from the backdrop of the effects of COVID on listed companies, particularly on their operational efficiencies, resilience, and ability to jump back from the effects of that, from a health, employees, business operations. And so from a survey that we did as the Nairobi Securities Exchange together with the Capital Markets Authority of Kenya, the findings were that indeed there was a gap. There was a gap on how companies appreciated the risks that were associated with the society, the environment, and even from a governance perspective. And actually, those companies that were able to jump back faster were those that, first of all, had the right governance frameworks, the right mindset, and the ability to actually leverage technology and move quicker and innovate. Those that were largely affected, of course, based on the sector that was largely hit, especially in the hospitality industry. So as a stock exchange and as members of the sustainable stock exchanges, our mandate was how do we help our listed companies? Should there be other pandemics or other instances that may disrupt business? And the first thing that came to our mind was dealing holders. There was a general understanding of what ESG is and generally what sustainability is. What was lacking is how do we actually integrate these ESG practices into our business models, into our strategies. How then do we go ahead and measure the impacts we have on the environment, the society, and even our governance structures? And even how do we set those governance structures for ESG oversight? And finally, how do we report? How do we disclose and tell our story around E, the S, and G to enable investors make investment decisions that are solid based on the information we give them? And so the manual that we put out at the stock exchange is a how-to document. It's a process flow document that details very in granular format how to actually set the governance structures right. How do you do your materiality analysis? How do you map up and prioritize your stakeholders? How do you measure your impact? All the way to how do you put the report content and eventually publish your report as a listed company. So that is a gap we meant to fill. And the benefit is it's a capacity building tool for all companies, listed or unlisted. Anybody can use it. Practitioners can also use it, those who are either sustainability managers or even CFAs or investment advisors, to just know how do you help your companies navigate this landscape of ESG and materiality issues that would affect the investments you make or you advise your clients to make. And this will help address some of the issues we talked about. If it's physical risks, for example, we talked of drought, we talked of investments in infrastructure, which can be affected or one way or the other by climate change, for example. And issues also of transitions, regulatory changes, for example. And how will that affect the investments you're advising your clients to go into or have already gone into? And what do investors need to know? So basically, it's a capacity building tool for businesses, which also investors will benefit when that information is put out to them. Thank you.
Yeah, thank you very much, Lois. And you've mentioned about various sectors that got a hard hit from COVID. And I think we can now look at, go to a sectoral approach. And one of the most active sectors we have in this country is real estate. And going on to Nasra, perhaps you could start with telling us a little bit more about the Kenya Green Building Society and what investment opportunities could be there for our clients in the real estate space.
Good morning, everyone. So my name is Nasra Nanda. I'm here as the CEO and ESG lead at the Kenya Green Building Society. I also am a special elect member of County Assembly at the Nairobi City County Assembly. So that gives me, I think, an interesting perspective on the challenges industry faces and also the challenges government face in terms of driving and collaborating with key stakeholders to ensure key objectives that are achieved from a government's perspective. So in terms of real estate and what we do as the KGBS, the Kenya Green Building Society, we are not
Great.
So in terms of the Kenya Green Building Society, we are a membership-based, not-for-profit society whose main mission is to drive the built environments towards sustainability. We do this through key stakeholder engagement, advocacy work, capacity building, and also certification. We are also the local implementation partner for the IFC Edge Buildings program, which essentially is a green rating tool that allows developers to build green and have the opportunity to access green finance. So what am I saying? I'm saying as KGBS, we are pushing for sustainability. I am also saying that we are trying to establish the business case for sustainability in two ways. One, if you go the sustainability route, entities like the IFC will look at you favorably and give you access to green finance. This presents an opportunity for the developer to access a new aspect of financing. But as CFAs, this also presents you an opportunity. If you understand the gap with respect to green financing, it also allows you to plug into clients who are keen to access this kind of financing. So as KGBS, we also do capacity building, which is tailored to the general public and more technical-based professionals. Because our aim is to improve the market, so we improve the capacity of the market to access these opportunities. Now, in terms of ESG and what it means from an investment perspective for real estate, I'll tackle it in three ways with a little background. So the way investors are operating has changed. They're not looking at just making money. Investors are also looking at how money is made. And they also want to understand whether their investments are hurting communities or helping them, or whether their investments are hurting natural resources or enhancing them. And also whether the companies they're investing in are inclusive and not discriminative. Think gender, think different or various ethnic groups. So investors are shifting their mindset. And once investors shift their mindset, this trickles down to industry, which then means this presents opportunities for industries, but also challenges if you're not with these changes. So what are the key issues or key opportunities for real estate, and what is relevant in this regard for you? I would say, under the E, I'll start off with the push for net zero. For those of you who know, we are still having the Conference of Parties 27, or COP27 in Egypt, which is currently ongoing. One of the key agenda items is the push for net zero. Essentially, Governments are now pledging, along with international organizations, to support climate-friendly investments or zero-carbon investments. This is particularly relevant for the built environment because buildings contribute to about 39 to 40% of CO2 emissions. So if we look at buildings not just as a hindrance, but a potential opportunity to address the climate issue or the CO2 emission issue, then you have a very, very good partner in any financing project that could be tackling a government agenda on a national or local capacity. The second environmental issue that you would look at is materials. So when it comes to buildings, one of the key things you would be looking at is using sustainable materials. Even better if they're locally sourced, even better if they're easily found. And what this does is that it also forces the market to look at alternative solutions when it comes to built materials. Here, we could say timber would be a good alternative material because it's easily available. And also from a CO2 perspective, it's one of the key materials that actually reduces CO2 emissions in the market. If we were to tackle the S in ESG for buildings, we would be looking at two main things. Affordable housing, which is a key priority agenda for the government. So if we tap in to the word affordable, a lot of people think affordable is cheap. I'd like to challenge you to think of affordable as also sustainable. Something that enhances the lives of the communities living in these spaces. This means they have to be safe from an environmental perspective so that people occupying these spaces don't get asthma, for example. So it's a health and well-being issue. As well as a revenue issue when it comes to saving on costs. So social aspects when it comes to the real estate industry is now gaining rapid momentum. In Nairobi itself, and generally now, and in the recent past, Nairobi County, Kiambu County, and Kajiado County are having a pandemic of collapsed buildings. Yesterday, 6 people died because someone somewhere didn't ensure a structural audit was done. And because of this, because the lack of being conscious of the fact that buildings are not just products for revenue, but they're also spaces that families live in and families need to feel safe, buildings from a quality perspective are not meeting the approval ratings. And you find a little rain, a collapsed building. People are dying because of that negligence. And so a social aspect for buildings is very important, especially now that investors are looking at the consequences of their investments. And lastly, on the G. When it comes to the G, there are two main aspects. Lois mentioned that there's reporting from the NSC perspective. You will also note investors now want to see what you're doing with your work on a day-to-day. So when we look at governance, we're looking at the benchmarking and reporting requirements, whether formal or informal. And ESG allows you to showcase what you've been doing from an E and S and G perspective. That then translates to the investor whether this is a safe bet, a shaky bet, or something that even they need to add in more investment, which is good for your business. And lastly, when you look at governance, technology is also a key tool in helping, tracking, overseeing, and also comparing data so that there are actual figures to back the business case for expanding and growing or diversifying your business. Thank you.
Thank you very much, Nasra, and bringing to light that the push for net zero is up and alive, and that means we may actually be called make commitments in our journey to go into ESG investing. And so maybe, Mehi, as we look at the opportunities available beyond the real estate space in ESG, should there be any concerns that we should look out for as we are either directly investing or guiding our clients into what they should put their money into?
I'm not sure again. No, I'm good. Okay, a very good question, and I will take exactly from where Nasrat had stopped, because I want to ask the audience, have you ever seen an ESG report being published by any company? It's a PDF. Sometimes it's colorful, like 300 pages, and all of this data regulators are asking for are being there. Have you seen how different it is from an oil perspective company and a bank, for example, or a real estate? Completely different. Everyone is saying whatever they want, however they want to be in scope, and where the term greenwashing has started. So everyone wants to be part of this flow. I want to be abide by certain regulations. I want to make the regulator happy about me. I want more money and attract investors, regardless of whatever is happening. And with this, sadly, incident that happened, it's not being captured. So this comes where data providers are. And I'm not trying to sell Refinitiv or London Stock Exchange's solutions, but I'll be happy to do so as well. But this is where we stand. So how are you going to quantify all of these qualitative measurements? Have you seen us spreading before? So we have to all agree on one thing. There are a lot of initiatives, a lot of directions and guidelines by regulators, by central banks, but no unified one. We do not have an African taxonomy to what an ESG is. Candice was mentioning that FTSE Russell is one of the businesses under London Stock Exchange Group. So the method how am I, as an analyst and a portfolio manager, would include all of this in my portfolio? How am I going to quantify it in the sense that when temperature increases by 1.5 degrees Celsius, unfortunately, this is going to affect my, my holdings and my portfolio. So all of this is very important. And not only this, and okay, so it's being reported by the company. I'm the best in the world. And again, sadly, events happen. I'll again refer to what Fred was saying, technology, solutions. We have at Refinitiv, we have what we call as a controversy score, or a controversy way of saying that even if you as a company report that you are the best in the world, you are giving living wages to the employees, actually in the social media, you are not. We are grabbing this information, we are putting it in a very neat, quantifiable way for you as an analyst, as a portfolio manager, as an investor, to start seeing how are you going to allocate your money. This is very important. So as a consensus, where to put and where to not to put, this is very important where data stands out. But if I only have the data and I don't know how to make use of the data, this is something else. So where ESG literacy is,
interesting because you've actually stated the biggest challenge we may have in this space. Everyone is talking about sustainability and everyone has their own definition of what sustainability is. And so they communicate sustainability in their own language. So how do we then create or enhance credibility in that information that is being shared?
Is regulation the answer? And if regulation is the answer, and I'm coming to you, Lois, with this one, we are speaking here different countries from Africa. So if you're speaking ESG, it's speaking different countries that where the markets are at different levels. So Lois, are we likely to be looking at a potential situation where we can have collaboration within the different markets to come up with like a taxonomy that speaks the same language, that guides the methodologies we are going to use, that will help us build consistency and credibility in the information we are reporting? And this is recognizing the fact that different markets in Africa, the capital markets, are at different levels. How do you see that playing out?
Thank you. Thank you for that question. And just maybe before I answer it, I want to go back to what Mehi was talking about lack of standardization. And I must say that locally here, this is Kenya, every company is at a different level of one, understanding this whole conversation about ESG, as well as even knowing or putting out their report. But where we sit as a securities exchange and also as a regulator is that this is a journey. It must start somewhere. So when a company starts small, in its simple way, it may produce data that maybe will improve over time. That to us will grow into this, it will mature into this ESG reporting and integration phase. Having said that, I think for each jurisdiction, and what I've seen in Africa particularly, the recommendation has to be to adopt a standardized format of reporting, and we as the Nairobi Securities Exchange have advocated or recommended the GRI standards or the GRI principles, which are the dominantly used standards, in the absence of a universal standard. As and when a universal standard is applicable, then the manual will still remain because the process is still the same, and that will still be applicable. Coming now to the regional and collaboration, I must say that this journey cannot be walked. Everybody cannot just go alone. We must collaborate, exchanges, policymakers, businesses, academia. Everybody must be in this whole discussion so that then the conversation diffuses, because ESG and sustainability is a way of life. It's a way of doing business. It's not just something we wake up and put and, a feel-good thing. It's the way we do our businesses, that we can make money, we can profit responsibly, we can make money while doing good. So yes, there's room for collaboration. As stock exchanges, we have the African Securities Exchanges Association, which is the umbrella through which most exchanges in Africa have actually been able to have guidelines for their own markets, which are all under using the GRI principles. We have Mauritius, we have Kenya, we have Ghana. Soon we are going to have a Dar es Salaam Stock Exchange and also the Rwanda Stock Exchange, also being helped by the GRI through ASEA to actualize some of these integration and the reporting frameworks for their jurisdictions. Yes, so there is room for collaboration. From a knowledge sharing perspective, I think collaboration comes where we can share lessons of how we did as Kenya, or where we are, how is the reporting taking shape, and we can compare that, because we don't live in isolation. Most of our African markets actually are foreign dominated from an investor perspective. So really we must align ourselves to what is required globally and see how we can customize that for our local context and invite the investors so that they can actually see what we are doing and attract the impact capital that we so dire need for Africans. Yeah, thank you.
Yeah, thank you very much, Lois, and it's indeed very exciting to hear there is a collaboration happening across the continent, across the capital markets. And in that collaboration, you mentioned that everybody has to come together to add value onto that, to the team. And of course, we cannot talk about sustainability without talking about the Sustainable Development Goals. And I think, in my opinion, personally, I believe the most important goal is the one on partnership, SDG 17, because everybody has to come together to make this a success. Where do you see the CFA society in that collaboration? What can we do as professionals to support?
The CFA society, Christine, these professionals are in the financial, banking, pension funds, the entire ecosystem that actually can catalyze change in sustainable financing. So really the role of the CFA is very critical. Remember, CFAs are the people guiding investments or giving guidance to their investors or clients on where to put their money. And also they will be approached by investors who are keen to put their money in particular segments that meet their personal values while still maximizing return. So really it's for the CFA one to equip themselves with the skill set. I think Fred brought up very well. We upskill ourselves we educate ourselves around this ESG conversation. And once we do that, then we will know how to assess investments based on the criteria of the E, the S, and the G. And when we are advising our clients, then we are sure of what we are telling them, and beyond that, we can incorporate data that will come out of reporting in making this advisory guidance to our clients. Yeah, thank you.
Yeah, thank you for emphasizing that. So upskilling is the word, and I think that's partly why we are here to try and shed light. This is actually just a light bulb. We are not actually sharing the heavy content here today, but I do believe we have opportunities and to be able to upskill and understand more about ESG investing. And so I'll go on to Nasra. Here you're in a room with investment professionals. This could be a make or break for you, maybe to pitch this. And I believe you already indicated the potential opportunities we've got in the real estate sector. But we are still, I think, doing business as usual in real estate without really taking into account ESG, and I'm not sure how much money we may be holding, or the participants in this room could be the portfolio, the value of the portfolios, but I want to imagine they are significant. And being significant, I don't also know the significance of the size of the portfolio as far as real estate is concerned, but I do believe real estate is a significant contributor of the returns in these portfolios. Now, what do you think are the challenges affecting the adoption of ESG as far as investments in real estate are concerned? And this is looking at it from a very, the big projects that we look at, that we invest in, and where institutional investors would be involved, because we've been seeing that pension funds going into the real estate space. So what are the challenges that could actually be hindering the adoption of the ESG or consideration for ESG in these investments?
Thank you so much for your question. To start off, I think I'd say one of the key challenges we have in the market, and not just from a real estate perspective, but generally when it comes to sustainability, ESG, is a lot of people in the market don't seem to understand what is ESG in respect of my investment, my next transaction. So they see it as some theory that a bunch of smart people talk about, but they don't understand what it means for them. The second thing is, because of that, there's a barrier. Because if they don't feel I'm part of that conversation, they already feel that's not something then I should be involved with. It's probably a banker's issue, a lawyer's issue, an environmentalist. So they don't think it's a Kenyan opportunity. They think it's an elitist opportunity. So for me, I'd start by saying we need to first sensitize the public on what ESG is, yes, but also what it means for them. What can it do for them? So as a starting point, I'd say the biggest challenge is knowledge, or availability of knowledge in understanding what ESG could do for a person. Doesn't mean they have to be a CEO. Could just be the common man or woman who wants to invest in something, and what this opportunity then translates for them. The second is, one of the biggest challenges I've faced is I've had investors, multinational investors, come to me and say, Nasra, to put it bluntly, we have a lot of money tied to sustainable finance. Put a figure, we can triple it, but we don't have the projects. In part, the reason they don't have the projects is CFAs, are not part of that conversation. When you're advising a client, have you considered advising your client on saying, yes, this is the vanilla way of doing things, but if you go through this, channel, number one, not many people are aware of it. So chances are there are a lot more investors who would want to listen to you because not many people are pitching with this, form of funding to invest in a particular project. And that's what our KGBS member, Acorn Holdings, did. For those of you who might not know, Acorn Holdings was, I'm not sure if it's the first or one of the first companies who took advantage of the green bond to finance an investment on student accommodation which was green certified. So they got literally the entire country behind them, and even the London Stock Exchange was behind them, and the NSE walked them, through the entire process. And it was because someone somewhere in that team said we could do things differently. I want to challenge you guys to be that person who tells your client we could do things differently. Because different means you are driving the narrative. You're not competing with other people. And if you do that, then you literally pull in clients to you because they see you as someone adding value to something that's not been addressed. The third challenge, I would say, is incentives. So it's not clear what the incentives are for building green to a lot of people or investing in green. From a real estate perspective, there's almost a perception that green means extra work, green means a lot more cost, and that might be true in certain cases, but it's not always the case. I'd previously mentioned by using alternative materials that could get you probably even a cheaper rate for designing a building. So it means when you're going through that route, you need to sit with financiers who could tell you what that means from a finance perspective. But you also need potentially a legal advisor who could tell you what you need to navigate from an obligations perspective or a timelines perspective. And lastly, you need to understand if it's the real estate market you're trying to penetrate from a sustainability perspective. As KGBS, we're more than happy to walk you through or connect you to someone who can walk you through some of those hurdles. But that's what you need to be thinking on. Industry knowledge, financial knowledge, and of course the regulatory environment, so that you can really maximize on the opportunities. And then from a tax perspective, I think it was in 2020 when the State Department of Public Works had issued a decree, and this is now something that KGBS is working on with the KMRC and IFC Edge, to push for a green affordable housing agenda. And especially now with the government prioritizing social housing as one of the key projects that they want to implement fully, fast, and are open to investment in different capacities. As Bwana CS earlier said, they want to look at new opportunities and shared prosperity. I think this is your biggest opportunity before you. I mean, it might look uncharted, but for me, when it's uncharted, it's better because you can, put it in your own handwriting and redefine the rules and change the game. So I think I'll stop there. Thank you.
Thank you very much, Nasra, and for highlighting those opportunities and also bringing out to light that or reminding us that we are fond of, as investment professionals, we tend to look at investments through the lens of quantitative metrics. And I think another challenge that has been in this space is what measures then do we use to quantify whether this is good for us or this is not good for us? And coming to you, Mehi, and perhaps because I know you are involved in ESG scoring, maybe you could tell us a little bit more about what are these measures or metrics that we could use that would help us understand, given where we are coming from, we are so metric loaded that perhaps it would be easier to start assimilating this information if we start from a metric perspective.
I love how you are so passionate about how ugly it is to have all of these matrices in place. And it is. So the thing is, as I was just mentioning in the previous question, is that it's in a PDF format. You imagine if only one report for only one company is around 300 pages. With one analyst who we assume that are fully aware of what ESG is going to spread everything like we do in a financial statement. Like, it's not like how it is, like total assets are there, which is equivalent to the liabilities plus equity, and the income statement, we have the net profit at the bottom. It's not. It's just all over. So very important that these matrices are being pulled out from these PDFs and being spreaded in a nicely format in the sense that you can compare. So how can I compare two oil companies together? By the way, only one oil company is not going to report, if they report, one time like the other. Completely different. Can you imagine the number of, the number of hours, resources, efforts that's being required by an analyst or a portfolio manager in order to include it in their analysis and attract foreign investors to come, whether from the COP27, if we got the pledges in place or whatever? Can you imagine? It's exactly the same facial expression that you have. It's a lot. So what data providers like Refinitiv are doing is that we do this for you. Over 640 plus matrices scattered all over. It's being gathered by, I believe our analysts are around 700 plus across the globe. They gather all of this data, and not only from the financial reports. So not all companies are reporting ESG data, by the way. We take this, whatever an ESG disclosure out there, and using the technology, NLPs and AIs, in order to take all of this and being put in a nicely format. I'll be more than happy to show it to the audience after we finish, in a way that you can put it actually in a score. How and where am I standing as a bank across my peers, or as an oil company, or in any other sector? And this is very important, materiality. I think that this is I believe it's a word that you are going to hear a lot. I cannot treat a bank like I treat an oil company from an environmental perspective, for example. So very important where I stand among my peers in the industry. And from this, taking it into the methodology, taking it from those 640 plus matrices going up to come up with what we call as an ESG score. Whether you are a quant analyst, or you are a discretionary portfolio manager, or you are just an investor who would like to see how can I put and invest my money in a mandate that suits my impact objective, that I want to have an impact on the Kenyan economy. I want to help people not being in sad incidents like what happened yesterday. So all of this is gathered in only one score. We combine it with something else, so we come up with all of this, like you got an A, you got a B, you got 100 out of 100, and it's your call how you can position it in your model. Plus, I combine to it a very important thing. I was just mentioning that everyone wants to abide by the regulations. I'm good. NSE is going to say that I'm good and I'm following the guidelines, but in fact I'm not. Where the controversy come, and we add them together. So whether this controversy is a negative or positive, you will have a total combined score where it includes both, easily being addressed and included in a portfolio and in your screening criteria. So all of this comes with an ESG score, or what we call it as an ESG score.
Thank you very much, Mahi. I'm sure the screening criteria, the scoring is something that we can resonate with. And so at this time then we can take a few questions from the audience, if there are any. Do we have any questions from the room? The virtual room? Yes, yeah, we've got one here and another one at the back. We have somebody with a microphone? Yeah, okay, the gentleman at the back first, and then we'll come to the front. Thank you.
Good morning, everyone. Thank you very much, and thank you very much for the great panel here discussing the ESG. My name is Vincent. I come from the renewable energy sector, so I'm a bit familiar with the ESG side of it in terms of how it's quantified, how it's measured, and the challenges around it. My question in this context, in the Kenyan context, ESG is a bit fluff. I can say, like, a lot of organization is still quite new. And also, as the lady said there in the real estate, is that it's very hard for you to really crystallize it to the average person in the street. And also to the financial people here, because at the end of the day, we are all capitalist society. I don't think there's any society in Africa where we can say we are predominantly moved from basic needs to now self-actualization, and now CO2 is our biggest problem, or and other things, or emissions and all that. So the question is how, in terms of data, do you quantify the return on investment on ESG basis? Because it has to start from profitability, then you walk down and say you can still make profitable and still be sustainable. And I think the challenge is always there. Where is the data?
Yeah, thank you very much, Vincent. Let's have the second question from the gentleman here at the front.
Thank you very much for the insightful engagements from the panel. My name is Bernard Kiari, the managing partner at Algamaka Capital, which is a management consulting and business advisory firm. And I'm also here in the capacity of a board member at CFA Society. So my question is really like a follow-up question to the previous question, which is basically at the company level, is ESG mainly for mature companies? And then what would you tell that small growing business that is still yet to gain market share, it's concerned about its marketing position, and so many other stuff that it's really thinking about before it even comes to start thinking about ESG? Thank you.
Yeah, thank you very much. And I think the two questions will go to Mehi. So it's about how you quantify ROI on an ESG basis. And also maybe Nasra, you can assist on the second one as to how, or maybe let's first get Mehi respond to the first one, then we can come Nasra to support on the second one.
Okay, so to answer the first question is that quantifying this qualitative measurement is not easy, bluntly. But how are you going to use all of the data being gathered from more advanced regions, let's say, that where I will use this as my benchmark in order to start assessing it and using it as part of my model, and hence I will start putting it and taking it from the financial ratios perspective. I will tell you something. I did it as an experiment with just using our ESG data scores, and I back-tested a portfolio based on these ESG scores, okay? And I found that according to the benchmark, and this is very important to choose a benchmark that is relevant to your portfolio in order to get appropriate attribution measurements, I found that I overperformed the benchmark over the period of 3 years by 23%. The way I did it, not necessarily the same way that anyone or you in the room is going to do it. So it depends again on what's your objective. So if your objective is alpha generation, okay, so how are you going to do it from an alpha generation perspective? Are you going to increase or to put mainly all of the weight of your portfolio in companies that have high E pillar score? Or is it from that you focus more on the social aspect, for example, that no, I will not put my money or in my universe and in my screening criteria, any kind of company that abuses the employees, for example. All of this that happens in the back office and in the back of your mind when it comes to how you screen for your universe, and then you start actually putting it in action, and where the information ratio comes out for portfolio managers and where is your input as a portfolio manager in this, there comes your ROI in a quantified way. So ESG is a factor, and this is very important. Are you going to include it as an enhancing factor in your investment equation or not? This is up to you. What's the weight of it in your equation? Again, this is up to you. Like whenever as CFA holders, you may know that it's not only about the DCF. Sometimes you include DCF and you put 20% for your peer analysis. maybe you're going to put the ESG factor as 10% and only 70% included in the financial part where it comes the sum of parts or the DCF model is. So again, it depends. But the main thing is that you need to know what's your mandate, what do you want, what's the objective, and then you will make use of this data to reach where you want to go. I hope I answered the question.
Yeah, thank you very much, Mahe. And then the second question we had from Bernard is about the focus on ESG seems to be a conversation that's resonating with mature companies. How then can we encourage smaller businesses to have consideration for ESG?
Thank you so much.
Yep,
thank you so much for your questions. I'd like to answer both actually, but I'll start with yours. So number one, ESG is not limited to mature companies. It's just mature companies have the financial bandwidth to shout that they're doing the right thing, or at least to be seen to be doing the right thing. So I would say ESG is something that is an opportunity for all kind of companies, starting up, small-sized, middle-sized, the works. The difference is what do you want to achieve from your ESG journey? Because it is a journey, as Lois said. So from my own research, the position we were looking at is starting off an action plan for ESG. What does that look like? It looks like 5 things. 1, you start off by building capacity or training. You need to ensure that you know what ESG is and what it can do for you, or rather what you want it to do for you. Once you've established that, then you look at the next level. Either you are where you want to be, or you're not. If you're not, then the next question is, what kind of support do you need? So does that mean capacity building? Does that mean collaborating? Does that mean having engagements with Refinitiv or with Lois to help you understand what you can do, right? Once you've done that and you've made progress, and assuming at this point in time you've started implementing certain things within your organization, and they can be as small as saying that we have a no working late policy because we value families, right? That's still ESG. I think a lot of people think you need to come up with very complex reports and that equals ESG. ESG is a journey, so if you start small, it's also sustainable. You manage and you do what you can at your level and then have the ambition to grow what that looks like over a quarter, over 6 months, over a year, until eventually you get to the point where your company's meeting its obligations, it's exceeding expectations, and then that can translate into a report that you might want to share either with your stakeholders or with potential investors, and that then makes it easier for you. I think the ESG journey is as simple or as complicated as you like, based on what you want out of the journey. Personally, I feel one step at a time works best because that's something you can measure and handle sustainably so that you're always moving forward or at least remaining the same. So I hope I've answered your question in that regard. Thank you. On the gentleman's comment, I think you started off by saying in Africa, we've not yet self-actualized. I think the most important thing I would want to start off by pointing out is there's this misconception that if you do the right thing, you're not making money. I disagree. I think you can do both. It might mean you have to be creative about how you go about it, but it doesn't mean picking one eats out into the other. I think one of the ways we can look at it is balancing people, planet, and profit. So it's a balance. It's not at the expense of something else. That's, as a starting point, what I would say. The second thing I would say is, just as I talked about, starting a journey in small steps, I think data is something that you can utilize to help you in even the small steps. For example, we have a member who is a mid-sized developer, not much in terms of revenue, but what they've been doing is, if they can communicate that, they've spent a lot of time investing and creating flats which were utilizing sustainable materials. The lighting is good, so you have natural lighting. You can breathe well because of indoor air quality. Small steps. What does that mean in terms of marketing? So they found by simply having that one-to-one interaction with each potential buyer that they've gone slightly above and beyond the norm to ensure comfort in any home. They found that those interactions then led to that potential buyer telling another potential buyer and another potential buyer. So it's marketing. So you find the frequency of people asking you about your product increases, and that then is something you can track from a data perspective. So I think that then helps you understand that if you invest in different ways to ensure you also care about the people investing in your product or in your service, then there's some sort of favorable investment, return on investment that happens. It might not look like potentially what you had in mind before you started the project. Maybe you thought, if I just say this is a good home, 10 people come in. But when you get into it, it's a different journey, because it might mean word of mouth might be slower, but you have certainty in people coming to buy homes because they know these are solid, not just from a structural perspective, but from a health and well-being perspective. So I think data is something that is not just hard, they're also soft metrics that influence return on investment. And I think that's potentially something that the finance industry needs to look at, because more and more people are also looking at the soft metrics and how they affect the hard metrics. So I think that's it. Thank you.
Yeah, thank you very much, Nasra, and for reminding us that you can do good and make money. I think we'll conclude the session now, and we'll start off with final remarks from Lois. 30 seconds. What's your parting shot?
Thank you. It's been a good panel. I think what I want to say is, especially for us CFAs, I'm not a CFA, but I'm now by assimilation. It's that we cannot ignore ESG in our investment analysis and advisory. So really, if we do that, then we are doing it at our own peril. And why do I say that? It will be an expensive mistake for you, because you'll have failed in your mandate, but also to your client, because you will have made them miss opportunities. The second parting shot I have is that this whole area of ESG is a career opportunity for a lot of us. A lot of us. We can innovate and grow and become experts in any of the channels, be it impact investing, materiality analysis, in private equity, advisory, all these things. Really, there's a whole load of opportunity for us to take. So really, let's upskill, let's be in the know, and let's have interest in this whole conversation. Thank you.
Much, Lois. Mehi?
In 30 seconds, I really, again, emphasize the same message. ESG is very important, and it's emphasizing the same message that all of our speakers now in the panel, as well as the keynote speakers, like President Francis has said, Moses has said, we need to have Kenya, or we want Kenya to be the financial hub. So to do this, we need to attract more liquidity. We need to make this capital market, it's really attractive for investors, and it all starts by us. I'm Egyptian, by the way, so I'm African. I'm not I'm a proud Egyptian. So yes, this is what we need to do. We need to put Africa again on the map when it comes to sustainable investing. This is what we want, and this is what's currently being negotiated at the COP27 in Sharm el-Sheikh in Egypt. So this is I hope I finish in 30 seconds.
Thank you very much, Mehi, and over to you, Nasra.
So I just wanted to say that as we speak now, our ministers and key negotiating leads in Egypt are talking to investors to see how they can secure finance for Kenya, finance for purpose. So whether it's social, whether it's carbon, whether it's natural-based financing, all of that falls under sustainable financing and ESG. So if they're fighting that hard, I don't know why you guys are relaxed. If I were you, I'd be finding out what they're talking about, so that when they do come back and release the findings, which they will, And if they don't, I urge you, look for that information. I'd be happy to share it if you're interested. But look for it because it will determine the next year, the developments around next year in terms of investments, in terms of opportunities, in terms of even the direction of government's priorities. So please, be proactive in seeing yourself as a game changer in this uncharted path, and ESG is your solution, and the sky's the limit. Thank you so much for your time. Thank you.
So thank you very much, ladies, for those thoughts. And I think the question was whether ESG is a strategic or compliance decision, or it's both. And I think it's very clear. It is not just one or either. It is most likely both, and we need to adhere to that. And I would like to thank the audience, and especially for not asking me why we only have an only ladies panel. And so please don't ask, because when you had the opportunity, you did not ask, so the opportunity has been closed. And we bring the session to an end, and thank you very much, ladies. Diversity, the panel. Diversity we may have failed, but looking at the whole portfolio of speakers, we may not be badly off. So thank you very much, and looking forward to more engagements.
Great, thanks Christine and your panel. Another proper round of applause to an all-lady panel. Fantastic, and thank you for addressing all the issues in such a vivid and clear manner. Great, ladies and gentlemen, we are slightly behind schedule, so I'd like to suggest a few things. One is that instead of having our tea outside, we would go grab the tea and bring it back. Again, grab the tea and bring it back. Again, grab the tea. Yeah, so we'll have a working tea, so if you could just grab your snack and bring it back, that would be great. And also, if I could have George Jetto, who is the moderator for the next session, and your team assemble right here for miking immediately, so that we're able to have this seamless. We'll try and ensure that we're able to finish the next two sessions by lunchtime, and so it will be very important that we stick to time. But the conversations are exciting, so I mean, you tend to forget about time, so I'll be here to remind you and pass you notes. But ladies and gentlemen, I'd like to invite us for a tea break, so if you could just make your way, grab your tea, coffee, and bring it back, and then George and your team could meet here, and then we'll get this going. Thank you so much. Okay, great. I'd like to invite you back in. Thank you for those of us who've already brought back your coffee and tea. We still need one panelist to be mic'd, so if you're in the room, please make your way to this corner. The gentleman here with a raised hand will mic you. Please welcome back. We need to get going, so if you could get back, that would be grateful. Asante. Okay, great. Last call. I'd like to invite us back to settle in. The next session is ready. So if you could just make our way. I'd also like to invite all our panelists for the next session. If you could just come and take your seats out front here. Okay, ladies and gentlemen, if you're still outside, please make your way in. Would like to start now. Also like to invite the panelists for the next session. If you could make your way to the seats in front. Okay, great. Last call. Last call. As we await for the start of the next session, we are happy that we've had quite a team of delegation online joining us via Zoom, and they've been sending their questions. Also, if you'd like to send your questions, there'll be limited opportunities to raise it on the floor, but you can also write, as well as you can use the hashtag CFA conference, and we'll be able to track them and share them with the moderators and the panelists to address them. So please do that. For the interest of those of us who are joining online, I'd like us to keep time and start now. So if you're still outside, if you're still standing, if you're still having a conversation, this would be a good point to settle in. Okay, and if I could have all my panelists seated, please. Thank you. So, in keeping with the theme, which is investing in an evolving environment, we've already been treated to very interesting thoughts by the speakers who came here before in the form of keynotes and special speeches, as well as the panel sessions. And we'll be looking at that, but this time round we'll be zooming in closer home with the question of deepening investments in the micro, small, and medium enterprises, and looking at the rise of African angel investors. You do know there's been a lot of conversation and excitement around the African startup ecosystem. So we'll be looking at how then do we create a space that is favorable for these investors. This session will be moderated by Mr. George Jato Otim, who is a CFA, Manager for Corporate Finance at BDO East Africa. Ladies and gentlemen, George.
Good morning, ladies and gentlemen. Yeah, my name is George Jato Otim. I'm a CFA charter holder, a board member of the CFA Society East Africa, also representing BDO in the capacity of a finance manager. I'm based in Kampala, Uganda. So just like it has been mentioned before, we're going to be looking at deepening investments in micro, small, and medium-sized entities, with a focus on the rise of angel investing in these companies. So a route to increase investment in micro, small, and medium-sized entities is angel investing, but we'll also be considering other alternative financing options. And angel investing has taken a significant stride on the African continent in the last 2 or so years, with investment exceeding 4.3 billion in 2021 across the region, and particularly in East Africa. According to the Africa Angel Business Network, ABAN Investment Survey 2022, 79% of the investors are founders, managers, and executives. And I believe most of the people in this room, form or take up these positions in various organizations. So during this panel, we'll be exploring avenues as to how we can participate in this recent boom in terms of having local capacity participating in this space rather than relying on foreign investors, plus also consider how founders can position themselves to receive funding. With me here, we have, I'll start from the right to the left, is Joram Winamo, who is the CEO and co-founder of SNDBX. He has 15 years experience involved in policy development and championing the growth of entrepreneurs in this space. He serves on the board of Amnesty International and is member of the steering committee of Aspen Network. Then to his right, we have Stephen Gugu. He's a finance professional with 15 years experience. He's the founder and principal of Investia Limited. He's also a co-founder and director at Victoria Ventures, an entity that manages Victoria Business Angel Network. He has been consulted widely on early stage initiatives supporting over 400 entrepreneurs. He has an MBA from Rarick Business School in Belgium and a law degree from the University of Nairobi. On his far right is Jafford Mwenda. He's the finance manager. He's the finance and administration manager at Stima Sacco. He has 14 years of experience in strategy formulation, executive business and corporate management. He has a master's in business administration and a bachelor as well, Bachelor of Commerce as well from Kenyatta University. He also obtained a senior management leadership qualification from IESE Business School. So we can get started. Go sit. Thank you. Perfect. Just a minute. So my first question goes to Mr. Stephen Ngugu, and as I've said, we're going to try and look at alternative investments and also paying a particular focus on angel investing. Would like you to explain to us what we mean by alternative investments, and given that also angel investing is a form of alternative investment, so could you kindly go ahead and introduce the subject? Thank you.
Okay, thank you very much for the question. I'm hoping that when I come for the next conference, I'll be also a CFA. 1 and 2. But one day I'll also add the CFA to my profile. But on the question of alternative investments, that's a loaded question, because we're talking about alternative investments for MSMEs, and so I wanted to first of all maybe think about what is not alternative, because there's so much that is alternative. It's difficult to sort of like say all the different alternative sources of financing. And so if you look at the traditional sources of financing, you have your debt, you have your equity, and of course you have maybe grants in this case that organizations or SMEs are able to receive. Now, anything that's alternative is what we consider as typical equity, but now altered to a certain extent. And so if you think about then from a debt perspective, you have mezz financing, which is anything that sits in between debt and equity. Could be convertible debt, could be preferred, convertible debt, could be, revenue-based financing, all those sort of like kind of things that you can add on top of that. If you think about the equity side, while people want to consider angel investing as alternative, at times I wonder whether it is alternative, because we all make investments in our personal capacities. You have a cousin, a friend who's starting a business, and every so often you decide to put in a bit of cash, and that's angel investing at the end of the day. So while it's alternative, one of the debates we've been having. Hello? Okay. There's a number of items we want to define, but it's just because they've gotten a new name, like investing. But whenever, I have a problem with my mic. Whenever you cash to a company, see? So I think whenever you put in cash as an individual into a company, as you know, this is not institutional money, that's angel investing, right? And we've been doing it. It's only that it has now been sort of like classified under angel investing. If you look about private equity and venture capital, that at times people want to say is also alternative, it's because it's not known, but I don't think it's alternative, because if you look at investment groups and chamas that we have in the continent, right? Every other country has chamas that they put together, and every so often they choose to make investments into companies, and that's private equity. It's just that it's not structured in the classical way that we read about it, that it has to be for a number of years, that then you have to exit and so forth, right? And so then if you go to sort of like, I think grants, we know what grants are, and then there's also other sources of financing which have come out, which are a bit different now. Things like revenue-based financing that you can speak about, those being alternative in this case. But generally alternative for me is, I guess there's alternative from the angle that it's not as well known, and then there's alternative in the sense that it's not structured the way the traditional financiers would structure things, right? So for me, that's what I would define as alternative investments. And then the other point that I think is important to mention is also when you're talking about MSMEs, that it's good to define what are MSMEs, because there's different types of MSMEs. You have your startup, right, which is the scalable venture, and here you can think maybe Twiga, Facebook, you know, all those kinds of companies that you want to speak about. You also have your livelihood sustaining businesses. These are family-based businesses. At times, there's no interest in terms of maybe telling them across the globe. They're principally local organizations, and they'll raise money. But from a growth perspective, you don't expect the exponential kind of growth that you see with startups. Then on the other side, you also have dynamic enterprises, which you can argue that they're typical SMEs to a certain extent, but which are looking to expand. They're not family-based, but they are, you know, they're more so like shareholders around the table, and they have this goal of expanding that. And so when you're talking about then how to finance them, you have to think about using alternative financing. You have to think about what's the type of entity. Then you also have to think about what's the stage of the entity. Because for different types of alternative investments, they are more suited for different stages of companies, whether it's a startup, it's mature, you know, it's a growing entity. So I'll leave that at that point. I'm sure the other panelists also have a lot to add on that topic. Thank you.
Absolutely. Thank you, Stephen. As you mentioned, one of the major investment entities in this space are the SACCOs or chamas. So there's no better person who is positioned to give us an idea of how that space has been panning out in the last couple of years than Jafford Mwenda. So could you just give us an indication from your experience in Stima SACCO, which is probably one of the top 4 SACCOs in Kenya, how you go about your investments in these entities as Stephen has described as taking up various forms. Thank you.
Okay, thank you so much. I would like to say MSMEs form quite part of our economic as a component, even when you look at the GDP that they contribute to. But they have a lot of challenges when it comes to assessing credit, getting alternative ways of investing what they make. So as a SACCO, or rather a world over, we are known as credit unions. That's the name that is used globally. We've sought to understand the challenges that they go through. And so these challenges is what we try and sort, or rather try promote them through. One of the things is that we don't have a very structured way, or rather our credit information sharing as a country, or also in East Africa, is not very well developed. You'll find out that you can be able to get information in the market about people who are defaulting loans, but also you're not able to get MSMEs that are doing so well. So what we sought to do is that as a credit union, we get people, we do member education, we follow through their savings, and then with time, because you realize that most SMEs fund their operations via savings, we try and stimulate these savings, so we give you a loan via a multiplier. That is, if you've saved 100K, we give you 300K. So with time, you create a class of assets of your savings, meaning that you get a return out of it. Then you're able to access credit from us. And that, in fact, what it has is, I know your CFAs, you know what is a net interest margin. So you're able to leverage on that. That is, as much as you're paying your loans, you've built a class of assets that is giving you a return. And so by that, you're able to grow your wealth faster than when you get credits from banks, whereby your rates that you're getting at are a bit high. And also something else that we do is that we lock the interest rate that we give you a credit at. That is, if you've given you a 12, even if things are panning out in the market in a different way or the CBR is being adjusted, we don't adjust that. So one thing is that you're getting credit from us, and also as you get credit from us, the asset that you're investing with us, you're also getting a return. So at the end of the day, you're able to do some sort of an asset liability management, and as well as expand your activities, or rather your business. Thank you.
Yes, thank you, Jafford. Mr. Joram Minamo, is there something you'd want to add to that from the angle of angel investing as well?
So good afternoon, everyone. First, I would like to say thank you for inviting entrepreneurs into the room. There are usually many forums where we hear people talking about us, and we are not in the room to give our perspective, especially of our struggles and challenges about what's not working or what's not working for us. And so it's a pleasure to be invited to the CFA Society. Also, you guys are a very intimidating group. I don't even have a CPA, so everything I know about finance I've accumulated by mistakes I made, and then when they now came to correct my mistakes, I learned what that thing was. So, we have failed forward. But that said, entrepreneurship is a very exciting journey. And entrepreneurs are really the value creators that help society move forward. I think in Kenya, it's just now that people are beginning to recognize that fact, that it's not government that creates jobs. It is largely entrepreneurs. Large organizations are always about optimization and cutting jobs, but entrepreneurs are the ones who are about creating new entities. And in their large numbers, they are the ones that end up creating the jobs that absorb the millions of people that need it. And so when we're talking access to finance, it's a very crucial topic because we are not able to, in a sense, fuel our businesses to scale when we don't have access to finance. And I think for a very long time, it's the bankers who led the access to finance conversation in Kenya, which in my opinion is very skewed because I've heard that even in certain markets, banking only forms 30% of the funding that goes into helping businesses grow. And so really we've been discussing the minority of the funding as if it's the only thing that gets businesses going. But the people who help businesses to scale are usually angels. Angels tend to be either former entrepreneurs or executives who have some extra money and they're able to put it into a new idea that would be able to grow. But as we've had, credit unions, SACCOs in Kenya actually play a very huge role when it comes to funding because your typical entrepreneur has no access to collateral, which is what banks need. And so, when they're able to save with SACCOs and they're able to, access funding, I've done it myself. I'm a member of a SACCO. Saved over a period of time, and then I've been able to access credits, especially when I really need it. And then as we were preparing for this, I was just mentioning to the team, there's probably other forms like what Stephen had mentioned, and also things like leasing are not very popular, but can be a very useful form of helping people finance. But at the end of the day, your average entrepreneur is not a very sophisticated business person, unless they've been in it for a very long time. And so you'd find that despite the fact that all these options are available, the average entrepreneur usually knows a lot about the product or service that they've built or that they are selling. Everything else is usually very foreign. Business management, financial, accounting, tax management, all these other things, investment raising, tend to be very foreign concepts. And I get into a lot of arguments with especially investment firms, because I'm like, people just look at the money component. They think if I give 500,000 to this business, it will grow. In many cases, you end up scaling the business way out of the realm of the entrepreneur's capacity to manage that money. And that's why a lot of investments fail in this part of the world. Because you give someone $500,000, their business scales to the level it needs very sophisticated management. They have their brother, their sister, their cousin running the business. They are not competent to manage Forex and, and all these other complicated financial instruments. The business will collapse. Then we also have challenges of values. You'll give that 500,000, an apartment will be built somewhere for 250,000. You as the funder come back looking for your money and, it's probably in somebody else's name and you're unable to recover. So we have a lot of challenges when it comes to funding businesses, yet a lot of opportunities. And bridging that gap just means that both the institutions and the entrepreneurs have to change their mindsets in terms of how they interact with each other and in terms of how they engage to solve the problem of getting them to access that finance. By the time you get to finance an average entrepreneur, you probably have to take them through a period of what we call cleaning up. You have to help them get their accounts in order. You have to help them get their business strategy in order. It's not just about the money. If you give me $500,000 and my total market size is small and I'm unable to sell my product, you're not going to get a return on investment. So you have to think about the business strategy. You have to think about the marketing. If the brand is not known, how will people buy the product? So you have to think about the human resource. Where are they hiring these people and training them from? And how are they managing them? Are they compliant with the labor laws, or will they end up in trouble with that? So entrepreneurship is very complex, and people, I think, underestimate that fact, and therefore we downplay what's required to enable us to get to the place where SMEs are fundable and scalable. And I hope people like yourselves will have that conversation a lot more, so that it's not just about the term sheets and the financial instruments, but also thinking about, do the people who we are funding have the capacity to absorb and turn around this capital into something useful? If we're able to crack that, there's no company I've consulted with that does not have immense potential. In fact, I always make them do a calculation of what amount of the total market size they're serving. Very few go beyond 1%, if you look especially from a Pan-African context. So the opportunity is immense, but the barriers that will get us there are quite huge.
Something? I think there's one point that I think is interesting. I mentioned that I never finished my CFA, and I hope I'm not kicked off the panel for saying what I'm about to say. I think one of the other challenges we face, I think in the financial services space, is the fact that most of finance theory and knowledge as we know it is not structured for this market, right? And that's why if you have your CFA and we give you a startup tomorrow and tell you value this startup, you'll be like, okay, I know my CFA, know all my methodologies, but I don't know what to do with this startup, right? So there's a lot of that experiential learning that to go through. And I think that then calls, and I think the previous panel spoke about this challenge of, how do we customize what we have? How do we, when you get your degree, you're told you're given the power to learn, right? That you get your CFA and you say, yes, I have my CFA, but once I go out there, I need to customize these to the environment I am in, right? And it's a challenge that Jorab is talking about, where a number of finance organizations are run by traditional finance people, and so when they meet with businesses, they're not able to understand or to structure the right kind of product to appreciate what the customer has. I'll give you an example. We've been working with a client who's, I think they're turning over maybe $2 million every year. They make supplies to one of the leading supermarket chains, and they need a working capital financing product, right? They don't have collateral, unfortunately. And it's been so difficult. We've knocked on so many doors, banks, alternative financiers, and it's either the risk is too high, so the pricing is done at 18-20%, and some of this is even in dollar terms, or you don't have collateral, can't appreciate what you have. But then these guys have cash flow, they have a stellar client on this other side. Like, how can we not be able to solve these as a simple issue, right? So I think that's the challenge, I think, maybe from the professionals over here. How do we structure what to meet the needs of the market that is not structured in that theory that we have?
Okay. Something else that has been challenging on this space is that MSMEs, they don't, when it comes to corporate governance, there's no that appreciation of having a board or maybe someone who can mentor you. You have the expertise, you have the technical knowledge, you've come up with a product that is transforming lives, but you don't have a board or someone who can advise you on the corporate governance or rather the structures that you need to put in place for you to scale the business to the next level. Or the business has gotten to a level that you're not able to manage, as Google was saying, to manage it by yourself. So we need, even as we do our consultancy services and what else that we do, we need to teach these entrepreneurs or these small businesses. They need to appreciate the element of corporate governance and know that simply because the business is yours, it doesn't mean that you cannot take ideas from other people. We need to appreciate that aspect so that at the end of the day, we can benefit from the expertise in the field and maybe scale these businesses further. Thank you.
Thank you all. It seems entrepreneurs are really struggling with managing capital from, these various entities. From experience, there's a business I invested in as an individual, as an angel investor, and put in a couple of, thousands of dollars, a couple of colleagues of mine as well. And the entrepreneur is struggling with school fees issues. So he eventually came and told us that he had used the money to pay school fees innocently. So not having a board in place, which may be expensive for them, but at the end of it all, if you're able to, at least equip them with knowledge on, their governance and these alternative investments, then the sky is the limit for them. So with that said, I'll just like to pose, I think, the last question to Stephen. I know you've also been involved in so many angel networks. So besides, having to deal with entrepreneurs being, misusing the money, the funds that they are given to them, what other challenges have angel investors been facing in this space?
So the challenges that angel investors face. So I think the biggest that I've seen is capacity, right? And I mean just knowledge. Because when you're looking at an early stage company, most people imagine it's a small version of a big company, right? And a small version of a big company has all the departments, only that it has only one person in each department. The only problem is that in a startup, there's no people in all departments. There's one person or two people who are all the departments. And the biggest focus is just the product. Once they figure out the product, is when they'll come out and say, okay, now we figure out the product, I think we need to figure out the finance, we need to figure out these other things and so forth. So a startup is not a small version of a big company, right? It's a company that's been created to figure out what's the right approach to address a specific solution, problem in the market. So they're figuring out what's the problem, they're figuring out what's the solution, and it takes a bit of time before they get to the point where you say there's a problem-solution fit, right? And so from that perspective, then it means that most investors, if they come from a traditional perspective, they'll come in and they'll say, you know what, you're a small company, before we can invest, we've done our valuation. Your valuation is, I don't know, let's say a small figure, and since you're putting this amount, you own 60% stake in this company. Of course, it doesn't work, because then the entrepreneur starts working for you from day one, and maybe they're not incentivized for that. So there's a lot of capacity that is required around, how do you source for good deals? How do you analyze a startup to know that this is a good startup to make investments into? What's your strategy? In fact, we start always with the strategy. What's your strategy as an angel investor? What kind of startup do you want to invest in? Is it in a specific sector? Is it in a particular stage, which means that it's not idea stage, it's people who have sort of like a solution, so to say, and they've started going to market. There's all those kind of things. And so one thing I tell angels is that before you get started, or even if you've already started, please look to attend some training somewhere around just angel investing to appreciate what it is. And we've created a platform. I'm going to, can I advertise a bit? We've been at this for a number of years. We've created a platform called the AfricaAngelAcademy.com. Right? And there we have all the content around angel investing, and it's facilitated by leading angel investors from across the continent. Right? And I think that's a good space to start. Then, so that's the first challenge. The second challenge, if you ask me, apart from capacity, is just the financial sort of like aspect. As an angel investor, you're investing your own money. And so I find that there's a number of angels who, their pockets are not deep enough, and they don't appreciate that angel investing requires pockets that are somehow deep enough. And I'll speak about this from this perspective, that for you to be a successful angel investor, you need to create a portfolio of companies. Just seeing one company trigger and saying, what, I found the best company, mortgage my house, put in all the cash there. Worst decision ever, right? Because of all the companies that you invest in, especially around, because angels invest in early stage companies, a number of them are going to fail. Basically, zero return. And so if you don't create a portfolio, then you'll end up in a situation where you may be lucky, where maybe the first couple that you make investments are successful, but the law of numbers is that probably, I don't know, more than 5, 6, portfolio of 10, more than 5 will fail, right? And so if you imagine that you start with the first, second, third, fourth, fifth, and they all fail, and the others are not supposed to be successful, and you don't have deep pockets to go the extra mile, that can be a bit of a challenge, right? And we saw this also during COVID, where angel investing almost slowed down because a number of angels, they sort of like became a bit conservative. Their pockets maybe are not as deep enough. And the solution for that is then to invest in syndicates. So don't invest by yourself. You may have, I don't know, $20,000. You can split that into 10 companies and co-invest with other angel investors, where then that becomes 10 investments that you invested $2,000. And if you want to back those, you can back them subsequently. Thank you.
Thank you, Stephen.
I wanted to add to what you were saying, because I find people really misunderstand entrepreneurship. The one thing you have to be very comfortable with in entrepreneurship is failure. And everything in our lives, I'm sure even in CFA you learn a lot about risk management. So you're being taught everything possible so that you don't fail, so that your portfolios don't fail, so that your returns to your investors, are better guaranteed. But entrepreneurship is about failure. You get very high statistics. It's usually 1 in 10 that survive beyond year 1. And then beyond that, there'll be a further mortality rate. And these are global statistics, it's not a Kenyan thing. But you find that markets that are very successful are very comfortable with failure. In the US, there's this guy called Adam Newman, who set up a company called WeWork, grew to over 40 billion valuation, and then blew up completely. Guess what? Adam just got $300 million from Andreessen Horowitz venture capital investment firm. The US is great at getting people who failed and funding them further, because now they're like, this guy has learned his lesson. And if we fund him again, he's going to succeed. Yeah? In this market, I don't even know where to start. Yeah? So we need to get comfortable with the fact that things will fail. As he says, spread out your risk, invest in multiple, because the factors that can make a business fail, we are really not in control. I think as human beings we want to think that we are, but we are really not in control. The founder can die, can get a terminal illness. So many things can happen that are not in your control, which you can do nothing about. So I tell people, just get comfortable with the fact that things are going to fail. Fail quickly, learn from the failure, structure better instruments down the line in terms of how to appraise your investments down the line, but just get comfortable with the fact that things are going to fail. So if you have $1 billion, spread them out 100, 100, 100. One will bring back 10, but there's quite a number that are going to fail. Be comfortable with that.
Thank you, Joram. At this point, I would like to welcome questions from the audience. If you have any question, please raise your hand. There's one online. Okay. I think we'll start with the person online. Then we'll follow up with you, Bernard.
George, there's a question online. Kate Kabajasi is asking, how can one access the angel investor for an NGO setting? Are angel investors profit-focused, or are they also development and growth-focused?
Should I, Steve? Oh, take another one. Bernard?
Thank you, panelists. So my question is around, we've been in this space in terms of PE and VC inflows from a funding perspective. So maybe Stephen and Joram, when you do evaluation as we stand now, has this inflows created value for businesses? If you're looking at it from an entrepreneur's perspective, Joram, can you say that these funds are creating value? They are strengthening the businesses? Yeah, so I think that's my question.
Is there any other we could take?
Yeah, so thank you very much. My question is around the funding, and maybe just to throw a spanner into the works is to think of, we've talked, you've mentioned failure is almost like a 90% guarantee. But I'm asking myself is, we have these multinational development banks that offer opportunities to reduce the risk or support innovations or early stage entities. Could this be an opportunity to strengthen or to create a stronger base for the success of MSMEs, or could this be viewed as a recipe for market distortion?
Thank you very much. My name is Alfred Kabuchu from Uganda. I have a few comments and maybe some of them as questions, but I'm also sharing. I also have a few years of experience, not just as a professional, but also as a person that looks for opportunities where to invest. I also happen to be involved with a number of savings groups in Uganda. We have one of them where we are actually 100 people, and we save and look for opportunities and try at times to act as entrepreneurs. My thinking on the challenges of angel investment, one is on the challenges we have with our ethical behaviors. I think not just as Ugandans, I think not just as Kenyans, but maybe as human beings. The question is, if I give you my 100 million shillings or $50,000, are you going to put it where it is supposed to be? Or like you said, I'm going to put some of it in that particular investment, and then the other half I'll put it in a business that is not above the table. I think the ethical dilemma is a serious matter that we all have to deal with, including the leaders at all levels. We've seen cases of where, even in schools, primary schools, when students are competing for leadership positions, their parents, who is us, we give them what they call facilitation to go and convince their friends in class to vote for them. And that system goes on, and you find that it is almost in every aspect of life, business, etc. And it comes back to haunt us when we are looking for investments or when we are investing. The other issue I've seen is the issue of the unstructured way our businesses operate. You go to the big businesses, they have systems, processes, they have auditors, they have each and every person. But when you go to the SMEs and at a lower level, you find the entrepreneur cannot afford to employ all these people. He's doing almost everything. Some of the information is in his own head. You can't even evaluate it. And yet, on the surface of it, it's like he's making money. When you try to invest there, your money may never come back. Then the other aspect is on the tax regime in which we operate. I don't understand very well the one of Kenya, but the one of Uganda, and from the little knowledge I know around East Africa. Our tax regimes are not necessarily very business friendly. We've been told over and over again that in East Africa we are paying around 12% of GDP in taxes, while in the developed world they pay maybe around 18+%. But what they don't explain is that if you are charging someone in Uganda or someone in Kenya a tax rate of about 30% or 40% if he earns above $3,000, you are charging 40%. For the person who is in the developed world, with that 30 or 40%, he has free education, he has free medical care, he moves on roads that are normal. But for you in East Africa, when you are paying 30%, on top of the 30%, you have to add medical care for yourself and your family. You have to add school fees. So in actual fact, you find effectively, as a human being, you are taxing yourself up to like 80–90%. And that is why many people actually decide to live outside the tax bracket. I think I may add on, but the last 2 points. There are many opportunities within our environment. When you see how the developed world operates vis-a-vis how we are operating in Africa, there is still a big opportunity gap. There is a big gap, and that gap for me I see as an opportunity. In terms of the ecosystem of the way their lifestyles are organized. It means many opportunities for us. How do we harness them? Last but not least is the issue of the cost of funding. You find like SACCOs, or we call them money lenders in Uganda, they are able to lend at up to 5% per month for people to borrow from their businesses. 5% per month comes to almost 60% per year, or even higher. They lend, they look for money, and there are people to take that money. The banks are lending up to 18 to 20%, less than half of that. But people can't get money from the banks, they go to the money lenders. The question is why? Why is it that people are willing to go and pay at a higher interest rate to receive their money, and yet they cannot go to the banks to pay a very low interest rate? And I think as professionals, as countries, as Africa, we need to deal seriously with the challenges that are involved with raising capital. Thank you very much.
Thank you, Alfred.
So just to answer very quickly, I should have explained, I run a space called Sandbox, SNDBX is Sandbox, and we support entrepreneurs with 33 professional services to formalize their businesses for scaling. So legal, HR, marketing, investor readiness, everything. So when he talks about informal SMEs, we are the guys who try to clean them up and help them become formal so that they're investor ready and they can scale. So value created by inflows from PE VC firms, there's a lot of value that has been created, and I look at it in terms of generations. I'll not name any names for obvious reasons, but I think there's a generation of businesses that has gone through VCP investing, maybe in the last, say in the 90s to the 2000s, and I think there was a lot of carnage in the investments that went in at that time, but I think they were the pioneers of getting Kenyans to learn about what external capital can do. There's a generation that has come after that I see your Twiggers and everything are experiencing, I think, better success, getting into better structured deals. I think before, people are getting into exploitative deals where their businesses are actually getting taken over and scaring entrepreneurs even further from accepting external capital. So I think we are going through a maturing phase of learning what external capital can do, what the structures required are. It's not unusual today to talk to entrepreneurs and you hear they're building to sell or building to get external investors, and they can talk term sheets, they can talk, cap tables and everything. That language is now more common than it was before. But I think we are barely scratching the surface. I think we have 1.6 million formally registered SMEs. Very few of those are getting investment or financing. DFIs can play a role, but as Stephen was saying, I think I'll challenge all of us. We need to get out of our comfort zones. And we need to get out of a comfort zone of particularly being informed by Europe and the US about the kind of structures that we should adopt for investment here. We're a very different market. I always say, even if a VC from Silicon Valley puts money into my business, how will they know that my biggest market comes from River Road or Gikomba? How will they even conceptualize that? Like, that doesn't exist in their countries. But yet that's where the money is being made. That's where the successful artists, there are people in Gikomba who have warehouses, who have billions of turnover. They might not even have a formally registered entity. They do their transactions. Someone showed me they turn over 10 million on M-Pesa on a monthly basis, not their bank accounts. So there's a lot we need to change about our mindsets if we are going to create structures that work for this market.
1 minute. There's so many questions to answer. I think I'll try to summarize. In terms of angels and where to get angels from, there's different types of angels. Remember that angels invest their own money. So you can choose how you want to invest your own money. So you have angels focused on impact. You have gender lens investing angel investors. You have for-profit angel investors. So it just depends what you want to do. You have different stages of angel investors who say, so I'll invest at idea stage and invest much later when the problem solutions fit. So angels are diverse from that perspective. And there's, of course, angels who want to get a return at the end of the day. In terms of how to access angel investors, there's an organization called the Africa Business Angels Network, which has a network of, I think, over 60 different business angel networks. So, if you, I don't know which countries are represented here, but there's a Rwanda Business Angels Network, there's a Victoria Business Angels Network, which I'm part of, there's NIBAN, there's Kampala Angel Investment Network. So there's quite a number of them. If you want to pick on that conversation, happy to share a couple of ideas on that. In terms of the value point, I won't repeat what, for PEVC, I won't repeat what Joram said, but I think we also have to ask, there's an additional question here. There's impact from the perspective of, the money goes out there, it solves a problem, right? But there's also the question of where do the profits go to? And that's the biggest question we need to ask in this room. A number of these stars that we're talking about, they're incorporated in the US, in Delaware, or in other jurisdictions, and the investors who put in cash are not Kenyan investors. And so when you see Twigger scaling over and over, when we eventually sell that company, the money is not coming here, right? And so there's that question around, because that's also impact, right? If you're asking what's the impact the money is having, we want to be, and that's what we should be part of this conversation. We should be putting money into these kinds of companies, because if we don't, in a number of years when we saw all these entities, we'll be like, yeah, but how come all the money is sort of like going the other direction? the last one here is just about DFIs. I think I spoke about the different types of MSMEs, right? I think startups should fail if they have to fail. I think we said, let's get comfortable with failure. They should fail if they have to fail, because I mean, there's some startups that we had some high-profile failures in Kenya, like Kune. People know about Kune. I think the other day we spoke about Sky Garden. Now, if you know about Kune, that's a startup that should not have been funded, in my view, right? And the fact that it failed is good. We should not be like, let's keep it going. No, DFI should pitch in more cash to make sure that it continues. So if it doesn't solve a problem, let it fail, right? We should be putting money in things that, are solving a problem and are scalable and so forth. Of course, that's different from your other types of MSMEs, which is your, small grocery shop and so forth that we need to support, because those are not just about the impact out there. It's also about the fact that that's a business that's feeding people. It's a job, actually, at the end of the day. So those maybe should get a bit of support. But startups, if they don't work, they should fail. Thank you.
Okay, I'll attempt to answer your question around the returns and the ethical dilemmas that we have with the investments. If you look at Kenya in our setup, in the late 90s or mid-90s, there are a lot of SACCOs and credit unions collapsed because of the same thing. So the government has done so much to step into that. We are regulated, like us, we are the first SACCO, deposit-taking SACCO to be regulated. So when you're looking at the value proposition or your return on your investment, at least you have a backup of a regulator who's watching over what you're investing. For example, maybe to put you into perspective, last year we had a turnover of around 6.8 billion. We distributed back 3 billion to our members, or rather our investors. If you look at how credit unions have played in this space, we are like 50. Our asset portfolio is like 53 billion. That puts at in the number of banks that you have in Kenya, that is around 43. That places us around number 16, 17 there. So we have a mindset of what credit unions do, but if you dig deeper, as my colleagues are saying, you need to know where you're putting your money. You need to know what type of return you want, what percentage you want. Like us Kenyans, I know you're obsessed with real estate. Most of the time, the return is on a single digit. But most of these, even credit unions or any other alternative investments that you put in, some of them are in a double digit that you can really enjoy in the long run. So let's evaluate all global value chains and the prepositions, the value that we get from them, and let's make a wise decision. And also something I want to insist on, when you're investing, say, in these new SMEs, or what you want to put your investment in, make sure it's something you're passionate about, something that you understand, so that you have some resilience. Even if it fails, you're able to go back and do something about it. Thank you.
Sorry, I know Bonnie is coming here to tell me that my time is up, but we are very enthusiastic about this topic, so I will ask the panelists to give their closing remarks in a minute, please. Stephen.
Okay, I would say just engage. I think there's a lot of opportunity. We have at Sandbox, we consult for maybe 2,400 small, medium-sized enterprise. We're barely scratching the surface of the total market size. There is so much opportunity in Kenya. In East Africa, people doing amazing things across the continent. There's just a lot of opportunity to innovate and grow new businesses that can create jobs. So I would say positively engage with people like ourselves, and let's see what new things we can create together.
For me, my parting shot will be, when you talk about alternative investments, we're talking about anything that's off the beaten path. And if we're going to have an impact as professionals in our markets, we need to realize that most of what we take from the theory, including the CFA, is not alternative. So we need to relearn. Yeah, we need to just go out there and just appreciate that there's so much content out there. There's so much that you can get out just out of experience working with companies on a day-to-day basis. So I think it would be just the idea of just relearning and trying to customize, because we need to solve our own problems, and at times the theory does not so fit our problems. Thank you.
Okay, mine is that 90% of the businesses that we have are MSMEs. They're providing over 50% of around 60% of employment. Yes, there are challenges. I would say our house is leaking, but it's not falling apart. So let's take advantage. Let's be part of the solution, not be part of the problem, and see what we can do to promote our entrepreneurs. Thank you.
Closing remarks. I think this is for Christine. Should mention that there's no diversity, but I think we had 4 ladies in the earlier session, and now we have 4 men, so it has even out. Thank you.
Fantastic. Thank you so much, George, and your team, and thank you for that deep dive into the nuances in the African startup investment ecosystem. So here's what we'll do. We have one brief, quick and painless session before lunch. So if I could have my panelists at this corner for like 1 minute of miking, and then the rest of us could stand. Just stand. Don't move out of the room. Just stand where you are. I promise it's not a trick. Okay? Okay. Once you're up, ensure that you're in pairs or in groups of 3, depending on where you're seated. Meanwhile, my panelists, you could just get here get mic'd. Tell the person next to you your first name. Ignore your title. Okay? Ignore CEO, doctor, president. Your first name, okay? You've told them? So I want you to tell that person to name 3 countries that start with the first letter of their first name, and then they'll do the same. Too bad if the person's name starts with an X. Go. Are we winning? Okay, please have a seat. Please have a seat. Who picked W? Anyone whose name started with a W? Nobody. Who picked T? Is there a Tony in the house? Please have a seat. Is there a Tony in the house? Timothy? Thomas? Gosh, what do your names start with? Those are T. Okay, please name 3. You said Togo? Tunisia? Tanzania? Okay. K. Kuwait. You guys are overthinking. Kazakhstan, wow. Okay. Y? Anyone with a Y? Yugoslavia? Yemen?
Hello? Okay.
Yugoslavia and Yemen only. O? There's an Onesimus in the house. Oman? Full stop. Anyone with a V? Do we have a Victor in the house? Venezuela? Only. All right, great. Thanks, ladies and gentlemen. So like I said, this will be quick and painless. This will go up to 1:30. Then we'll break for lunch. There's an exciting afternoon session where we'll go into breakout sessions, into smaller groups that will allow us to get deeper into some of the issues. Also will be treated to a fantastic performance here of comedy, but more importantly, there'll be drinks, okay? So please hang around.
On the other aspect, what attracts FDI, I believe, is also the enabling environment that enables investors to consider, for example, a particular jurisdiction to invest that money in the opportunity. And I feel like in East Africa, we have a great, I would say, appreciation for both ways of attracting FDI, such as Kenya, for example, and Uganda and Tanzania for sure, where investors are really keen to come and invest because there's a lot of opportunity and there's great opportunity to also scale and grow. But then we also have markets such as ours that are relatively smaller, but at least we present that opportunity for an enabling environment, for an investor to be able to come and set up, domicile, with an interest in going beyond. And so really in terms of attracting FDI, we've seen that in Africa, across Africa, we now have a record of 83 billion of FDI that has recently come in following the last, of course, the COVID effects. And that's a great opportunity. That shows great momentum, that there is opportunity. And so it's really up to us to take up that opportunity and to see how our countries can be best positioned to further attract that deployment of capital. Thank you.
Jadeja, what is driving the shift into establishment of international finance centers in East Africa? Is there something that we can learn from the Nairobi experience?
All right, able to face is lower. And basically, as a financial center, as Nairobi, what we're trying to do is that we're trying to attract capital to spur economic growth and development because the opportunities are certainly there. And we're trying to look at the operating environment and trying to see how can we make it better, how can we improve it so that the capital can come here. The second thing, for example, that's driving also the development of the NIFC is that we've seen that there's an opportunity not just to invest, but also to link businesses in the region and in Kenya to grow the investment opportunities. Where can people invest? I think in the previous panel, we said that there's an opportunity for technical advising businesses to scale, to grow if they have the kind of professional support. So that's also another reason why we're also developing an environment that's also attractive, not just for finance, but also the right kind of talent that's able to help businesses grow and grow the opportunities and basically lead to economic development.
Thank you. Let's talk about investor rights. We had a situation in Uganda twice. Funded parties have tried to use the legal system to wriggle out of investment contracts. We had a major player who was funded to put up a hotel and went and argued that the funding he had received did not have a license to operate within the jurisdiction of Uganda. And the initial courts agreed with him, which created a lot of upheavals. What are we doing differently to give confidence to foreign investors that their money is well protected and they don't need to have a presence in our jurisdictions to bring in foreign capital? There are some ideas that you are bringing on board from Kigali and Nairobi in terms of the IFC that will give them that comfort. Are you able to share some thoughts?
All right, I think I'll go first. So yes, indeed, because part of the operating framework, like you've said rightly, investment is about contracts. So having a dispute resolution framework that's able to address the needs and any disputes that arise, and having these issues and to listen to these issues and resolve these issues in a fast manner is very important. The second thing that we are doing is that we are actually working with the judiciary. We have a proposal that we have presented to them where we want to set up a specialized court. It's going to be the Financial Services Court, where we're looking at having judges who are very familiar with financial services contracts in the center, being able to sit at this court. And because it will only be hearing matters from the financial services court, the case loads will be much less and will be fewer, and be able to facilitate fast tracking hearing of these cases and having these issues resolved, not over a number of years like we have seen in other courts, for example, but in a period of time that's acceptable to investors, so that we also don't unnecessarily lock up capital in dispute. So the quicker these disputes can be resolved in a court that people appreciate, in a court where you understand that the rules
and it's about putting in place those, I would say, standards and guidelines that facilitate for such cases to be administered. And the other thing is I would want to call out is also the expediency of how it's done. So for example, in such cases where that occurs, for example, I believe our government has really put in a great effort in ensuring that there's that efficiency in the process and how cases are managed. So beyond having in place and working in collaboration with the Arbitration Center to put in place those guidelines for dispute resolution and arbitration, it's also ensuring that it's actually done in a timely manner. And so for investors, that is critical, really. And I think we felt it more also when we started this initiative or ambition to become a financial services center ourselves, is investors do have concerns, and the concerns is about, do I have the assurance that my investment is protected, And also when you're serving as a hub, is do you have the assurance that you can also repatriate your capital once you've made the return? And so there's a lot of effort really going towards that and ensuring that there is alignment with what we are doing with international standards, but also regional standards, I would say. Thank you.
All right. Thank you for that. Bernard, we haven't ignored you. Where I come from, you first serve the ladies, and then the gentlemen can take the juicier parts of the chicken. But Bernard, we had in the morning the Honorable Minister highlighting the mushrooming competition. Kigali IFC is leading, Nairobi is emerging, Kampala is watching. What can ESC do? Do we all want to create, become IFCs in our jurisdiction, or is there a framework we can think about to jointly participate such that we can attract capital as East Africa? Are there any thoughts you can throw around for us to think about?
Thank you. Thank you so much, Alan. One thing that the IFCs should consider is, the region is in need of capital. That is given. But again, if you look at, you benchmark across the globe, the IFCs that are there, you can look at Zurich. That is a niche IFC. So they are into banks, banking, private banking. And when you look at also, there are some IFCs which are pushing themselves regional IFCs besides being international. So it is for the IFCs within the region to collaborate and see, okay, where does our strength lie? And then how do we link to the needs of the region? So Nairobi International Financial Center could say, okay, fine. Besides being an international financial center, then we are going to focus on, say, Africa. Because, it is not limited, you're not limited to Africa. Because an IFC, anybody can come and raise funds for development, individuals, corporates, as well as government. So it can be an HIFC, it can be a sectoral also, You can say that we are especially in a given sector, as well as being our global IFC. Now those ones are the New York ones, the Dubai ones, and also maybe being a regional IFC. So it is sitting together, discussing and seeing where does our strength lie, where can we create impact. Thank you.
All right, thank you. So in terms of the evolution of Africa, we've seen the creation of the Africa Continental Free Trade Area in terms of facilitating intra-Africa trade. How do we layer that into the visions we are building in our markets? Is it something that is following on to facilitate the AFCTA, or is it a competing arrangement that is going to be country focused? What thoughts would you have there? How are you positioning to participate in those arrangements?
Okay, when we look at Africa and Continental Free Trade Area, it is quite interesting. It also makes us think about what is our performance in terms of attracting foreign direct investment. Because then for us to trade, we have to generate product, isn't it? And for us to generate product, then we have to improve our industries in-house. So let me just, allow me to give you a few statistics in terms of what we attracted for the past, say, 3 years in the East African community. So like in 2019, 2021, in Africa, we had 45.6 billion in terms of foreign direct investment inflows. In 2020, we had 38.9 billion, and then in 2021, last year, we had 82.9 billion in terms of investment inflows. Now, out of that, in 2019, the EAC accounted for 17% of that at 7.8 billion. In 2020, we accounted for 9% at 8.1 billion. And in 2021, we accounted for, in 2020 we accounted for 15% and 2021 9%. So when you look at this, it shows that for us to be competitive again within the ACFTA, we look at how do we ensure macroeconomic stability, because that is the only way that, besides the natural resources that we have, if you talk about natural resources in Nigeria, South Africa, all these people have it. But then now it boils down, why should somebody choose Kenya or choose East Africa and not West Africa? What is our macroeconomic stability like? For the CFS, I know, you do the pestle, isn't it? It wraps up what it means to be macroeconomically stable. So when you look at all those areas, then check now, what can we do to uplift ourselves? First of all, investor will look at what is your infrastructure network like? If I come and invest, will I be able to have my goods into the market? The rail network, the airport. But you look at the rail network in Kenya, developing, and then now the region should focus on regional network, road networks and rail networks. We have got international airports, like JKIA ranked the best in Africa in 2019, and currently at category 1 status by the USA. So when you look at these infrastructures, and then you look at the laws that can help investors choose East Africa and not the other areas. And then also we look at what are our niche industries, where do we want to focus on? And then we promote East Africa as a region. You see, there is competition, yes, but you can say that, okay, come and invest in East Africa. At Kenya, we say that think investment, make it Kenya. But you can say think investment, make it East Africa. So that we, the EAC has the Common Market Protocol, and they're also trying to work on the monetary union. So in these things, when we bring them together, then focus more as promoting the region as opposed to individual countries. And then we'll be competitive in the continent. Thank you.
All right, thank you for those comments, Bernard. But turning back to the ladies, where you are operating in is very interesting and new for most of us. Is it possible for you to shed some light on how does the business of an IFC make money? How does it work? Bernard here works for KenInvest. How different are you from KenInvest, for example, Jedida? Are you duplicating, or are you a completely different business? Hortense, how do you make money? How different are you from RDB? Yeah.
Okay. Thank you for that question. And forgive me before I get to it. I think it was really important, the conversation around the continental free trade.
Sure.
And just piggybacking from what Bernard said, there is an index that sort of looks at the competitiveness of financial centers. It's called the Global Financial Centers Index. And there's a research they did to show how the growth of financial centers over time, about 10 to 15 years, I believe. So in Africa, 15 years ago, for example, there was only one financial center. And then come to today, we now have 15 financial centers in Africa and the Middle Eastern region. So now, you can only imagine if, with the latest UN report that came out that shows that FDI flow in Africa will increase by 100% because of this continental trade. You can only imagine the opportunity that now will arise and how we are actually going to see many more financial centers coming on board. So I think this deepening of economic integration and the broadening of services will really play a great role in attracting more. And I believe now financial centers will play a great role that even Kampala can have that niche positioning depending on the unique offering. So it's really a great opportunity. And now to us, how we compare or differ from investment authorities or investment bodies. So I work for Rwanda Finance. Rwanda Finance is the investment promotion agency that is promoting this initiative, the Kigali International Financial Center. So while Rwanda Development Board is our main primary investment promotion agency, attracting investment into Rwanda, what we are doing is focusing more on the financial services sector, and we are now trying to see how we can promote and position ourselves as a financial services hub. And so our call or our mandate is to see that we are attracting capital into our economy, but also to see how Rwanda can serve as a base for any actors, even in the region or the continent, to use us to deploy capital in other markets beyond Rwanda. So Rwanda Finance is an agency, but Kigali International Financial Center is the initiative to help us position ourselves that way. And that's how we differ.
All right. Zayda?
We get that question a lot, almost everywhere I go. But I think you have to, let me take a few steps back and talk about the financial sector is really a facilitative sector when you look at the wider, let me call it the real economy. So when you're talking about the real economy, I'm talking about the manufacturing sector, I'm talking about the agricultural sector, just where the real business is happening, where goods and services are really being generated. The financial sector is supportive of that and facilitates and enables that sort of economic activity to even take place. So when we talk about what are we doing as an IFC, so it draws me back to what is the definition of an international financial center. It's a marketplace. It's a marketplace for financial services and products. But more than that, it's a center of excellence to be able to access financial services and products by all these other real economy industries. So what we are trying to do as the NIFC is to create an operating framework where financial institutions can be able to provide the services and the products in an environment that enables them to do so at a cost-effective manner, so that the real industries are able to access finance in that's affordable. And you were told affordable is not necessarily cheap, but it's affordable in the sense that when they access that capital, they're not spending all of their revenues repaying capital, so there's some of it left over for them to grow, to expand, and to even, take advantage of opportunities like those that will come up through the continental free trade area. So again, for the NIFC, we focus on the financial sector. We focus on developing this marketplace that makes it efficient for businesses to come and be based in the NIFC, and it's the same thing for Kigali. They're developing their own center to be a center of excellence. So now, different financial centers usually tend to specialize in different financial products and services, and so that's coming back to the question of should everybody develop their own financial center. I think the question then comes back to what Bernard said. It's we look at our strengths and we look at what can you offer in what area can you develop and be efficient in? Because IFCs compete purely on the basis of efficiency. So if Uganda, if Kampala can efficiently be the center of banking, better than Nairobi and Kigali, that's where banking institutions will be based. And from there, they will serve the region. If Kigali is a center for, and just pick an area and they're a center of excellence better than, and they can offer it better than the rest of us, then people will obviously gravitate to Kigali for that, and Nairobi the same. So when you're talking about the marketplace, it's what are you a center of excellence for, and that's what you will be known for. And so competition is obviously encouraged, because the wider market, the real economy, is going to be better for it. So if the Kenya manufacturer can get better capital from trade capital from Kigali, by all means, that's where they should get it, because then that will spur even both Kenya and Kigali's economies in that manner. So how do IFCs make money? It's really not about how we make money, but really how are we able to spur economic activity in the real economies to spur economic growth and development. That's really the role of the financial sector, and it should be seen as that. So any concessions that are made, for example, through tax incentives, people would argue when you give a tax incentive, you're reducing revenue to the government, but that's just one way of looking at it. The larger picture of looking at it would be, okay, so you give this concession in terms of, say, having the tax. So if you're supposed to pay 30, you get to pay 15%. If you're able to finance the manufacturing sector and unlock the potential in that sector that hasn't been unlocked due to lack of affordable capital, then the government will generate more revenues from that sector and spur economic growth in that sector, and basically lead to greater economic development, industrialization of the economy, less reliance on one sector of the economy. So do this, look at agriculture, look at manufacturing, look at the real estate sectors. So if you're able to unlock the potential that's there in the real economy, that's basically how financial centers support economic development and growth. And that's basically what we're looking at. How do we leverage the financial sector to develop our economies and our countries and our continent as a whole?
Thank you. Bernard, coming back to you, circling back to you, how is Kenya Invest supporting the positioning of Kenya in terms of attracting capital? What are you doing differently from the NIFC?
Thank you, Alan. Allow me to take you back to your biology classes. I don't know when you did it, but taking the analogy of the body, right? And then we know that for us to move, then we'll have to have oxygen in our, the heart will have to pump blood onto the legs and to the head and everything. Then we'll be alive. So for, as Jareda says, that for the economy to be alive, the financial services sector acts as the blood that pumps, takes the oxygen to all, because, you have to use money. And money is associated with the financial services sector. So again, when we promote Kenya as a destination for investors, then some of these investors may say, okay, fine. Yeah, we have got wonderful opportunities. There are those you want to do infrastructural development, you want to grow your manufacturing sector, but then where do we get the money? So then that is where NIFC comes in, and we say, okay, fine. We have got investors or companies or financial institutions at the NIFC who can be able to fund your venture. You don't need to go and look for. So I'll just tell NIFC that, okay, we have investors here who want to invest in the infrastructure. They want to do
country, then we'll be able to have a list of all of that, and that's how we're able to work in a complementary manner.
All right, so those are very interesting insights that you share there. But for the audience that we have here, they are interested.
We're taking efforts to bring that talent in. How do we as investment professionals partake of these opportunities? Do you have anything you can share with us today? You can start with us.
Thank you, Alan. Yes, well, I think what makes a financial center an international financial center is the ability to facilitate cross-border trade and investment. And for us, with the Kigali International Financial Center, it's really about enabling and accelerating that to enable economic development for Rwanda, but also how we serve the region. So now the areas that we're looking at in terms of attracting, we are positioning ourselves to see how we could offer the opportunity to become a fund domicile, for example. And one of the, I would say, the industries that we're looking to develop that will allow us to achieve that is the funds industry. And we are looking to attract a lot of, I would say, service providers and professionals who have the expertise in investment management,
but also the key, I would say, sectors that support that industry. You know, you won't really have a competitive funds industry without the banking, you know, without the insurance, without the capital markets. You also will need the service providers who support that, you know, the lawyers, the tax advisors. So we are really trying to attract professionals who have that expertise. And for us, because the funds industry in Rwanda is relatively nascent, we are looking to attract from our own diaspora, but also leverage the expertise we have in the region to come and support us in this initiative. And that's for the short term. But in the long term, is how do you build your own ecosystem to be sustainable in the long run, you know? So, and what we are doing is that we have a plan in place to see how we can upskill our local ecosystem, and is clearly defined in terms of professionals we're looking to attract. Our government recently passed an occupation in demand list, and what this means is that it's a list of professionals that we seek out, and wherever we get them from, they're able to easily come and get a work visa because they're supporting this particular industry to support us in that. We're also looking to put in place the programs, the CFA, for example. It's a big one for us because we do not have that many financial analysts and professionals, and they are the foundation of this whole initiative. So we're really looking to upskill in terms of bringing on board programs as well that can upskill our own local professionals. So it's a two-pronged approach in attracting the experts, but at the same time also building that pool from our own ecosystem.
Yeah. On the Kenyan side, I would say you have a lot of talent.
Exactly. It's not a problem. You just picked it from my mouth. I will just going to tell you, Adam, look across the room.
There are many Ugandans in there.
And then tell me, because if you look across the room, these are ladies and gentlemen who have eaten finance. They have digested finance. They breathe finance. They sleep finance. They wake finance. And finance flows in their blood vessels. So we are a hotbed of talent. Thank you.
Jidide, are you dissenting?
Yes, in a way, because from the research we've done is, I think the challenge to the people in this room, I don't dispute that we've got talent in Nairobi, we do. But from what we've heard and from the discussions we've had with various people is that it's not enough. So I guess my challenge to people in this room is you really, beyond the qualification, you really have to build yourself up and really set yourself to become the best financial analyst, not just in Kenya,
but in the whole of Africa. You really need to learn your market. I think the previous panelist said, so you're done with your education, you're done with the schooling, fine, that's good. But do you really understand your market? Do you understand the aspects in your market that differ? So when you have these international financial providers coming here, you want to position yourself in a way where you understand this market so well, and not just East African market, but also I challenge you to learn the various markets that there are. So if you want to be a specialist for East African market, be that, and make sure that nobody knows more about the East African market than you. And the reason why I say this is because with IFCs, you're not just competing amongst yourselves and amongst East Africans, you're competing with global talent. So if, for example, let's say BlackRock comes and is based in Nairobi, asset managers, they will look for talent in Nairobi, in Kigali, in East Africa. But if they're not happy with that, they will bring the talent from London, from USA, from wherever. So the way you want to position yourself to take advantage of the opportunities that are there in the financial sector is be really good. Be the best financial analyst that anybody, if they were to look for anybody in the market, even somebody coming from London would not even hold a candle to you. So we do have, but it's not enough, which is why we're talking about attracting talent. What you need to do is make that irrelevant. We do not need to attract talent if you people develop yourselves to such a level, skills level, that you're globally competitive. So we're not even just talking about competitive in the East African sector. We're talking about globally competitive. So if you're Ugandan and you need, and a company is based, say, in Kigali, they will pick you over somebody in Kigali. If you're Kenyan and there's a Rwandese who's a better financial analyst than you, believe you me, the financial institution will pick the Rwandese in your own country. In Nairobi, they will hire that Rwandese in Kenya. And so the challenge here is you really need to grow, you really need to upscale, and not just upscale to be the best in the region, upscale to the level where you are globally competitive anywhere. So that would be my challenge to you, so that we stop talking about attracting talent and have that talent readily available in our market. That's how you're going to be able to take advantage of the opportunities of the IFCs that are developing in the region. And I guarantee you, the firms pay much better. So you can be incentivized by that for sure. Earning New York salaries in Nairobi, I think that's an attractive offering for you, why you need to go the extra mile to develop your skills level.
Wow, great stuff. Our time is short, so this is a very interesting conversation, and I will encourage the audience to pick up with the speakers, the panelists, as we go through lunch and the afternoon. But as we are coming to a close, let's take a minute just for wrap up. Hortense, Bernard, and Jedediah, do you have some thoughts in a minute or so you can share with the audience? What do you want them to take away from the conversation today? And of course, it will also be helpful for you to share your outlook in where you are standing. What do you see evolving, and how they can participate in that evolution? And I'll start with Hortense here. Yeah. You can share with us your closing, your wrap-ups, but also your thoughts in the future.
Thank you. Thank you, Alan. So I think in East Africa and as East Africans, we all have great ambitions for economic development. Rwanda has its Vision 2050 to be a high-income economy, for example, and Kenya has its own vision as well. Uganda has its own vision, and they are all ambitious goals that really target accelerated economic growth and development. And so it's a question of what will be the key driving factors for us to be able to reach there. And I think really that's the driving force behind why we are all setting up these initiatives to become even financial centers or financial hubs. It's to allow us to leverage the financial sector as a pillar for that. And as Jedidah mentioned, it's to support the real economy. At the end of the day, the investors we're attracting, majority of them, at least for our case, they're not going directly into the financial services. They are going to support healthcare, they're going to support tech, agriculture, because those are the big, I would say, they form the big percentage of our GDP. So it's about how are we facilitating them to get to that point and ultimately supporting our economies. Now, at the end of the day, you need to have an ecosystem to get there. So for us, our big, I would say, focus is on the talent and on the skills, the people, really, to support us to get there. And it's about building that readiness to enable us to get there. Because if you want to become a high-income economy and set up a financial services hub, what do you need? What does it take? The government has done a lot of work in putting in place the enabling environment. For example, in Rwanda, we have passed laws to support investors who can come and set up new structures, trusts, foundations, funds, partnerships, And we've also had or put in place tax incentives to allow more cross-border investment and engagement. Now it's upon the private sector and it's upon the professionals to take up these opportunities. There's so much the government can do, but it has to be private sector led. And we need to have the service providers and professionals to support the journey and ambition. So my call out, I think this is such a great forum to be able to engage and speak with different professionals who have the same mindset, to be able to understand what different countries are also working towards and see how we can collaborate to build our own ecosystems and professionals to get us to that point. So that's what I can say.
Great stuff. Yeah. Bernard.
Allow me to link the topic to the CFA. Okay. Allow me to link the topic that we are discussing, an investment hub, to the CFA society. There's an analogy that if you open a shop, ensure that you have stock, right? Because you cannot open an empty shop. So for us to attract investment, be it domestic, be it foreign, then we need to have stock. And stock that we should have is bankable investment projects. Those which an investor will see, you'll pitch, and it will be taken off the shelves. Now, we find that if I could just go back to the previous panel, there are those venture capitalists, angel investors, and all of them. They'll look at a project and either decide to take this one and leave the other one. Now, the CFA society will play a critical role in ensuring that investors who come do not go back. There is an aspect of projects that is giving entrepreneurs a nightmare: financial modeling. And we have the expertise here. So I would encourage the society to go out of their way to be the best financial model, those who can do financial modeling and help the projects to secure investment. Thank you.
I think on top of what I said before, so I said upskill, and this is a personal initiative. So just to give you an example of how you could do that, if you're in an organization where you're able to seek secondment into a different market, to go and learn and see how things happen in that market, just go learn into that market and maybe even come back. That's one way of upskilling. So I don't want to tell you upskill and not tell you how, but that's an example. Increase your exposure. That's one way of doing it. I think that's what's most relevant to your members. And I think the second thing is, I don't want to repeat what has already been said. I think you people are very critical in making sure that businesses are well packaged when it comes to bankability and investability, being able to analyze businesses and be able to showcase why investors should be able to invest in this, the returns that are likely to come out of it, or even just simply just providing advisory to some of the MSMEs, because that's one of the challenges that that industry faces in terms of being able to attract capital. So I think the members in this room, the members of this society are actually one of the key people that we are going to rely on as a country to be able to get investments, and we're talking about global capital into the right kind of investments. So I think that's really my challenge to all of you, is that there's a great opportunity here where, and I said there's also a great opportunity to improve your personal economic prospects, but really it's really how you get to participate in this economy and trying to improve it and really driving our nation towards a like I said, according to us, Vision 2030, an industrialized middle-income country. We have until 2030, so I think the timelines are very clear to everyone about that. So thank you.
A big round of applause for our panel. These have been very insightful discussions. Personally, I've learned a lot. And Alfred, we have a competition. We need to go back and start also building a Uganda IFC. But as it's been highlighted that there is different flavors of these. Yes, please.
Doesn't start with a K.
No, that's why I'm using Uganda, because now it can't be Kampala. But we shall figure it out along the way. But thank you very much for listening to us. I hope you've picked one or two things. We've been delighted to have this audience. This conversation is heavy, I know. But as we go through lunch, let's take time to interact and ask and interact with the panelists. I know they have a lot more information to share with us as we go along. So thank you very much to the panel and to the audience. Thank you again for listening. Asante.
Thank you. Thank you so much, Alan. I know there was so much pressure for time, but that was a wonderful conversation. Lots of challenges, lots of practical solutions to carry away. And thank you so much, panel, for sharing your candid thoughts on this. So we really appreciate. So, ladies and gentlemen, that brings us to the first break of these proceedings. We will be going for lunch now. So you will pick your vouchers at the exit and head downstairs by the pool. That's where we'll have lunch. We are trying to save on time, so we'll try to restrict lunch to 30 minutes if possible. Okay. Then once you do that, we could head back here immediately. So here's how the afternoon session will look like. The afternoon session will have 2 breakout sessions where we'll use this as room 1. So on your programs, where it says room 1, this is room 1, and room 2 is a room next door. So if you could just get back here and they will give us instructions on what happens then. We'll have 2 sets of breakout sessions. So we'll have the first set, tea break, and the second one that will wrap up the day. Obviously, we have also already let you know that we have a fantastic entertainment presentation by Amandeep that will be coming up later on. But also more importantly is that there'll be drinks, okay? So please don't go away, hang around. We'll be having a wonderful session. So lunch will be served, bon appetit. Just head out, pick your voucher and head downstairs. See you in the afternoon.
Yeah.